Yes. So let's continue with where we had stopped in the last session. But before we continue, let's quickly revise. Okay? Yes. What are the concepts that I had covered in the last session? Do you remember? Tell. MIRR I had covered. Yes. MIRR, then modified NPV, then what else? Capital rationing. Okay, then what else? Equated annual cost or equated benefit. Then that's all, no? Only these many concepts, right? Something else was covered. Adjusted present value was pending, correct? Yes. Okay. What is MIRR? How do you calculate MIRR? First step is present value of cash outflows. Yes. Second step is future value of cash inflows. Then present value of cash outflow is equal to divided by 1 plus to the power n. Interchange the places, you get the value of MIRR, correct? Yes. Okay. So that is your MIRR calculations. Okay. How do you compute modified NPV? Same two steps. Present value of cash outflow, then future value of cash inflow by using reinvestment rate. Yes. And then third step is present value of cash inflow by discounting the future value to present value. Then finally fourth step is modified NPV, which is present value of cash inflow minus present value of cash outflow. Now, third concept that we covered was capital rationing. What is capital rationing? When we have limited amount of capital, but we have various projects which are all beneficial, maybe from NPV point of view, profitability index point of view, all are beneficial, but we have limited sum of money, limited resources to invest in. That is where we come into finding out what is the profitability index and go with those projects which are more beneficial in terms of NPV as compared to the ones which are less beneficial. So capital rationing is a concept which comes into picture when you have limited capital. Okay. Now under capital rationing, we had discussed two types. When the projects are divisible and when the projects are indivisible. Correct? Divisible projects and indivisible projects. Now in case of divisible projects, a part of the project can also be undertaken. So if you are doing project A, B, C in fully, project D, project E, whatever remaining projects are there, a part of it also can be undertaken, and that is what is called as divisible projects. Coming to indivisible projects. Indivisible projects is where a part cannot be undertaken. You have to do it fully or you cannot do it. If you have the money to do it, you can do it. If you do not have the money to do it, then you cannot do it. So in case of indivisible projects, we go with checking out which project is giving us the highest NPV. By trying out different combination of projects, we come to a conclusion as to which of the projects is giving us higher NPV. That is what we do under indivisible projects. Okay. Then we did the equated annual cost or equated annual benefit method. Cost or benefit depends upon the information that is given to us in the question. Doesn't matter if it is cost or it is benefit. In the equated annual cost or benefit method, you need to realize that the life of two comparable assets are different. Correct? We had done a question of expensive machine and least expensive machine, where life of one machine was 12 years and the other life of the other machine was 6 years, where we understood that when the expensive machines project can be done once, the least expensive ones can be done twice. Less expensive ones can be done twice. So over there, direct comparison is not possible. That is where we come to a conclusion of finding the equated annual cost or equated annual benefit value. So how do we do this? We regularly compute the NPV, either in terms of cash outflow or in terms of cash inflows. Okay, basically net present value, whether it is outflow present value or whether it is inflow. So if it is outflow or inflow, both doesn't matter. You divide it by the PV factor of that many number of years, whatever is the life of the asset. We are not dividing it by number of years, we are dividing it by the PV factor of that many number of years because it's a present value computation that we have done. Once you do that, you will get the equated annual cost or benefit depending upon the previous information. If it is cost, lower equated annual cost will be considered, and if it is benefit, the higher one will be considered. Is that clear? Yes? Okay. Fine. I think we had covered till here in the last session, and we had done 1 or 2 questions. Let's continue with the questions. Which question had we finished? 10 we had done, 11 we had done, correct? 14 also we had completed. Okay, fine. Come to question number 12. We'll do the adjusted present value method at the end, okay? We'll finish off the remaining 3 questions, that is there. 3, 12, 13 and 15 are there, yes. Yes, read the question. A plastic manufacturer has under consideration the proposal of production of high quality plastic glasses. The necessary equipment to manufacture the glasses would cost 1 lakh and would last for 5 years. Full stop is missing there. 5 years it is, okay? S is missing, then full stop. The tax rate of depreciation is 20% on what? Written down value. So which means that the depreciation is going to change every year. So definitely even if the profit before depreciation and tax is same, the depreciation value is going to change every year. So we have to do the different 5 years calculation. Okay, next. There is no other asset in this block. There is some relevance for this. There is no other asset in the block. I'll come to the explanation in a while. Okay, I marked it and kept. I'll explain it to you. Next. The expected salvage value is 10,000. That means at the end of 5th year, it can be sold for 10,000. Next. The glasses can be sold at rupees 4 each. Regardless of the level of production, the manufacturer will incur cash cost of rupees 25,000 each year if the project is undertaken. Now they are saying that they are producing glasses. Each glass can be sold for 4 rupees. And when you produce glasses, regarding of your level of production, every year you will have to incur some cost of 25,000. That cost is cash cost, which means there is outflow of money which is going to affect the cash flows of the business. Is that clear? Okay, next. The overhead cost allocated to this new line would be 5,000. So any cost that is allocated here is how much? 5,000. 5,000 is the overhead cost that is allocated to this particular line of production. Next. So there is additional cost of how much? 5,000. Next. The variable costs are estimated at rupees 2 per glass. Now we know that sales minus variable cost is contribution minus the fixed cost, which includes depreciation also usually, but I'll write depreciation here separately. Minus fixed cost minus depreciation will give you a EBIT. Correct? From this you will minus the taxes. You'll get your earnings after tax. You'll add the depreciation. You'll get the cash flow after tax. Is it clear till here? Everyone? Okay. Next. I have to explain something over here also for you. I'll come to it. Next. The variable cost is here. So 4 rupees is the sale value, 2 rupees is the variable cost. So contribution per glass is 2 rupees. Next. The manufacturer estimates it will sell about 75,000 glasses every year. So how much is the revenue every year? 75,000 into 4. Very good. How much is the variable cost every year? 75,000 into 2. Basic information is here. So contribution every year is 75,000 into 2, that is 1,50,000. Is it clear till here? Okay, fine. Next. The tax rate is 35%. Should the proposed equipment be purchased, assume 20% cost of capital and additional working capital requirement of rupees 50,000. Okay. Now, two things that we need to understand, right? One is there is no other asset in the block, and one more is I have underlined the overhead cost of rupees 25,000. These are the two things that we need to, 5,000, not 25,000, 5,000. These are the two things. Now, when they say there is no other asset in the block, now as per income tax, there is something called as block of assets. Now, what happens when there is no other asset in the block? There is something called as 15% block, 20% block, and so on. 10% block, 40% block, all these. Now, what happens? Now, right now, I'm not going to teach you what are the different blocks. I'm only going to tell you what happens when all the assets in the block are sold. When all the assets in the blocks are sold, then there comes a concept of capital gain. I'll repeat, listen carefully. When all the assets in the block is sold, then there comes a concept of capital gains. Now let us say I have these two iPads over here. Okay, I purchased these two iPads. There's one here and there's one over here. So now I have sold one of these. When I sell the first one, it doesn't matter. You just minus the salvage value from the WDV of the asset. You go ahead with the remaining part as normal. But when I sell the second one, that is where both the assets in my block are getting sold. There is nothing left in the block. So I had only these two assets in the block. I sold one in the first year. Next year, let me say, I sold the other one. So what happens is, the second asset when it gets sold, because the block ceases to exist. The block, what happens? Ceases to exist. That means there is no other asset in the block. That is where capital gain or loss will come into picture. And when you talk about capital gain on sale of asset, it is always short term in nature. What is short term, what is long term, all these things you will learn when you go forward in your direct tax paper. Right now, I'll explain you how much is needed here. Okay? Because that is again an in-depth explanation of capital gain, which I cannot do it right now. How much is needed for your syllabus to understand it, I'll explain over here. So I'll repeat again. What it means is, over here, no other asset in the block means there is whatever asset is there in the block, when it gets sold, it attracts capital gain or loss. Okay? So that is what we need to compute, is what we need to understand over here. Is that clear? Yes? Okay. There's another point that I've underlined. Overhead cost allocated. Now, what is this overhead cost allocated? Allocated means something that is given to this line of production. Allocated means the entire company is incurring the cost. It may have different lines of business. Out of that, they may have total overhead cost. Total overhead cost, out of which a part is allocated to this line of business. Can I say that irrespective of whether this line of business is there or not, overhead cost will be incurred? So allocated overhead cost is not only for this particular line of business. So it is that particular element which is not relevant for decision making over here. I'll repeat again, listen carefully. These 2 points are very important in this particular question. I'll repeat, listen. One is block assets. When block ceases to exist, capital gain will be covered. Capital gain or loss. How to calculate? I'll tell you. But what you need to understand here is when block ceases to exist, gain or loss should be considered. How to do it? I'll tell you. That I have not explained it to you right now. That we'll do it slowly when we're doing the solution. Next, allocated overhead cost is something that is put into this particular part of production. So total may be 1 lakh. The company may have 4 different units. They have equally allocated the overhead cost. It could be the cost of selling an administration unit. It could be the cost incurred for something which is not directly in relation to this particular production of glasses. So overhead cost which is allocated in nature will not be considered for computation of NPV, because no matter what, if this line is there or not there, that cost needs to be incurred in other forms. Is that clear? Yes, it is not specific for this particular element of production. Have you understood till here? Everyone? Yes? Okay. So read the question once again. Okay. Read. I'll ask you some values. You have to give me the answers for it. Read the questions. Of lights you want to turn off. I don't know where the switches are. You just inform the staff. I think they do it. Where are the switches of these lights? Anyone knows where the switches are? Just inform them. I think they'll do it. It's there? Okay. Fine? No, not this. That you turn it on. Huh. Which one? That one only? That one you don't want? No. The first one that you did, the first one that you switched off? No. That tube light you want on, huh? The second one? No. 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 Fine. Always the last one. Okay. Fine. Read the question. Which one? Okay. No. These are fans, I think. That's fan. No. Then there. That's it. Trial and error. No. No. I think you have to tell them only. That is the case. One of you. You will read. Yes. Just read the question. Don't waste time. What we keep from obsession? What is that? Yeah, who is that?
It's a movie.
Oh, it's which movie? Movie reference, huh? What type of movie is this obsession movie? Horror, psychotic thriller. It's switched off, no? Any idea when will the power be there?
So it's running at UPS only. Turn on AC means 15 minutes. You can take after that. You're not responsible for it.
So we manage till we can.
We have contacted the electricity board. Okay. He says that it will come as quick as possible.
I know it's difficult. You want to open the windows? You think it will be helpful opening the windows? I think it will be even more hot. Because the temperature outside, dust. Because the temperature outside is even hotter than the temperature inside the class. I don't know, I feel like that. We'll see how much we will do it. I think that class is cancelled. That's what sir said, bye, and he went. They don't even have proper power. I mean, it's not in our control also. Okay. I am burning here. My hands are started burning now. Okay, anyways, it's okay. Let's not think about it. Let's focus on the question. Class getting cancelled. No. Not yet. And hopefully no. All this story you have in mind. What is the cost of the asset, guys? What is the cost of the asset? 1 lakh. Okay. After 5 years, how much can the asset be sold for? 10,000. Okay. What is the number of years? 5 years, right? Yes. How many units of glasses are sold every year? Okay, fine. Is the depreciation going to remain same every year or is it going to change? Because it is under WDV method, correct? So can I say that the sales will be same every year, the variable cost will be same every year, contribution will be same. Fixed cost is going to remain the same every year, that is 25,000. But depreciation is the only cost that will change. So we can compute up to profit before depreciation and taxes as one working note. Okay. Then we'll do one more working note for computing the cash flow after tax and then multiply it with PV factor to get the discounted cash flow after tax. Is that clear? Did you understand till here? Oh. Then salvage value is given, but they have said there is no other asset in the block, which means you have to calculate gain or loss on sale. Okay, for that one adjustment is there. When I solve it, I will tell it to you. Okay, how to do it. Otherwise, too much of information will happen at once right now. Next, what else? That 5,000 we will ignore. Cost of capital is how much? What is the cost of capital in the question? Yes, 20%. And what is the tax rate? 35%. How much is the working capital needed? 50,000. So can I say working capital is additional fund that is needed to start the production process? So can I say in the first year, that is the initial year 0, additional 50,000 will be invested in the business, that is 50,000 outflow. And in the last year, terminal year, you will get the 50,000 back. Is that clear? Yes? Okay. So all these things are things that we need to understand. Now slowly when we put on the working notes is where we'll understand what we are supposed to do. Is that clear till here? Okay. Shall we start writing the working notes? Yes, write down first. Question number? Okay. 3 things you have to compute. One is PD of initial outflow, then present value of subsequent cash inflows, okay, and then terminal value of cash inflow or out. Usually inflow only will be there. Okay. So working note, write down first. Computation of present value of initial investment. What are the outflows of year 0? Purchase price of the asset, how much? 1 lakh, very good. What else? Additional working capital, how much? 50,000. So how much is the total? Is that clear? Anything else that you have incurred at year 0? Nothing. Okay. Right. Particulars and rupees. It's always good to write it in the form of table so that it's clear and presentation is nicely done. So under particulars first, cost of the asset 1 lakh and what? Additional working capital, no? Yes or no? 50,000. So total is 1,50,000. This PD of cash outflow also you can say. Both are nothing but the same over here. Everyone? Yes? Any doubts until here? Can I go to the next working note? Any doubts? No? Second. Shall we compute the profit before depreciation and taxes? Why only till depreciation and tax we are computing? Because depreciation is different for different years. So since depreciation is different for different years, that will change. Because of which the tax calculation will change. Because of which the cash flows after tax is also going to change. So right, working note 2, computation of profit before depreciation and taxes. In the bracket for your information, if you want, you can write PBDT will be same for all 5 years. Same heading, particulars and rupees. We start with sales revenue 75,000 into 4. How much is that? Yes, 3 lakhs. Less what? Variable cost. How much is the variable cost? 2 rupees per unit, correct? So 75,000 into 1,50,000. What will be the contribution? Minus or less fixed cost excluding how much is the fixed cost? 25,000 is the cash cost and 5,000 is the allocated cost. Will we include the 5,000? No, we'll include only the 25,000 because that is specific for this project. Allocated cost is not specific for this project. It should have been incurred even if the project would not have been undertaken. It is allocated to this project because this project is there. Yeah. Yes. How much? 25,000. So what do you get? 1,25,000 profit before depreciation and tax. Everyone? I hope you are doing the table. Lines and all are drawing. Can I go ahead? Yes. Working note 3. Calculation of depreciation. Working note 3. Calculation of depreciation under WDV. Calculation of Here we have to do the calculation year on year basis. Okay, so we'll draw 3 columns. First is the year column. Next is the depreciation column. And last is the WDV column. How many years? 5 years. First year you write. First year on what value will you compute the depreciation? On 1 lakh. What is the rate? 20%. So let me write here. Here you will write 20% on WDV. I'll write here. Okay. Then here I'll write first one in the bracket 20% on 1 lakh. How much is that? 20. So what is the WDV? WDV is what? Cost minus cumulative depreciation. Correct? Yes or no? Huh. What is the WDV? Tell me. 80? Did you understand how is it 80,000? If you want for the first one, I'll write the computation. 1 lakh minus 20,000. Second year. Tell me, what is the depreciation? Very good. 16,000. What's the WDV? 64,000. How 64? 80 minus 16. For those who are confused, I'll write it for year 2 also, so that there is clarity. I think after this, you will not have any problem how to calculate the remaining parts. Can you tell me for third year? Okay, 12,800. 51. 10,000. 40,960, no? Wait, right till here. Wait. I have to explain something to you. Depreciation will not be calculated. No, depreciation. What's the relation between depreciation and profit before depreciation and tax? It will be computed on the cost, not on PBDT. How to identify that for what all we need to prepare working notes? See, I told you to prepare working notes, you need to prepare it for the initial outflow, subsequent cash flows, and for terminal cash flows. Initial is done. For calculating the subsequent, we need the cash flow after tax. Now, what are the elements that affect cash flow? The elements that affect cash flow are sales, variable cost, fixed cost. Now, here in this particular question, the fixed cost when it comes to depreciation is different for different years. Hence, you have to do a separate table for computing depreciation and a separate table for computing cash flows after tax. Because PBDT for all the years is going to remain the same, but depreciation will not remain the same. So, when you minus the depreciation from PBDT, the profit before tax will change. And hence, you need to have a separate table to compute the profit before tax, then minus the tax, then add the depreciation to get the cash flow after tax. Okay, everyone? Yes. Right, 5th year, nil. I'll tell you why. Listen. This is something that I have not explained yet. Listen carefully. Did you understand how to compute depreciation till year? Which year is the asset sold? 5th year. The year in which any asset is sold, in that year, depreciation will not be computed on the, it is not an allowable expenditure. Is that clear? You remember when I began the chapter, I told you, we are minusing the depreciation to calculate the tax because depreciation is an allowable expense for computation of tax, correct? Yes, but as per the computation of taxes comes into picture, depreciation cannot be charged in the year the asset is sold. To charge depreciation on the asset, it should be there in the business till the end of the year. Even if it is sold on the last day of the year, it is considered that the asset is not there for the entire year. Is that clear? Since the asset is sold at the end of 5th year, here it is considered that the asset is not there for the complete year and hence no depreciation will be charged in the last year. Is that understood? So the WDV will remain 40,960 itself. Did you understand? Yes. Okay. I'll make you write a note here. Very hot. We'll try for some more time. Yes. We'll try for some more time. I know, I can understand. For me to hear one fan is that even after that, I'm feeling like suffocated. I know, I understand. I'm not saying I don't understand. Online, it is easy for you to say we will try till break. You come here and sit, you will get to know what is our situation. Literally, everyone is blowing air with their fans or books or whatever they're getting in their hands. And over the point of time when you sit in this weather, you will not feel like even concentrating. I know, I understand. We'll try. Someone is saying, I'm in my room with AC. Even we are in AC, okay now. Now don't say anything. Let it remain. Here. Okay, write one note here below this. Right here. Asset is sold. Right. Asset is sold. In the 5th year. And hence no depreciation will be charged. Asset is sold in the 5th year and hence no depreciation will be charged. Done? Is it clear? Very good. Everyone. At what price is the asset sold? At the 5th year end, at what price is the asset sold? For 10,000, correct? What is the WDV of the asset? 40,960. I'll repeat, listen carefully. At what price is the asset sold? 10,000. What is the WDV of the asset? 960, correct? Yes? Oh. Can I say that the difference is nothing but the loss on sale of asset? Is that clear? Everyone? Did you understand till here? Yes? Okay. Right. Working note 4. Computation of loss on sale of asset. Right. Loss on sale of asset is equal to WDV at 5th year minus what? Salary. or sale price also you get 40,960 minus 30,000. Can I ask you something here? Listen now. I'm going a little bit beyond the question. I'm changing the element of the question. Okay? Please understand what I'm trying to say. Let us say the sale price of the asset. Sale price of the asset at 50th is 50,000. Sale price is how much? 50. Sale price is 50. WDV is 40,960. So now you tell me, will there be a loss or will there be a profit? Profit. So you can compare the WDV with the sale price. If the WDV is less than the sale price, profit. And if the WDV is more than the sale price, then it is a loss. Is that clear? Everyone? Okay. Somewhere in your notes, so that you don't miss out on these things, maybe here. You can write it as a note. Right. When the asset is sold and the block ceases to exist, means what? There is no other asset in the block. When the asset is sold and and the block ceases to exist, and the block ceases to exist. In the bracket, if you want to write no other asset in the block, then profit or loss on sale shall be computed. WDV more than sale price, then it is loss. And if the WDV is less than the sale price, then there's a profit. Anyone? Is the AC actually working? No, I'm having a doubt. It got switched on and I think switched off. It's working. It'll take time. Is it clear? Clear? Everyone? Everyone? Okay. Now listen. I am not having any feeling that it's working or not, but I will do this. Temperature will reduce. Will vary percent. Is it clear? Everyone? I'll tell you some implications of it right now. Listen. Whenever there is a loss on sale of asset, there will be a tax benefit or tax savings because loss will be considered like an expense. And whenever there's a profit, you end up paying taxes. So there is implication of this in the last year for the payment or the benefit on tax. Is that clear? Okay. Everyone has understood clear how to compute it? I'll come to it. Okay, but why are we computing this loss or profit? It's because there is some tax advantage on loss on sale of asset. Is that clear? Okay, next, right now. What is that working on? PBDT done, depreciation done, loss on sale done, present value of initial outflow is done. Now we have to compute the present value of cash flows after tax. That is another word, subsequent cash flows. Right now. Computation of present value of cash flows after. Right, let us write it in the row manner, okay? Like not 1, 2, 3, 4 columns, row way, right? So that we can, no, we don't. We can actually write it in the other way around also, both will work. Okay, no problem. Because there's not a lot of lines that we need to write. We have to start with profit before depreciation and tax minus the depreciation. You get the profit before tax. Then minus tax, add depreciation. Multiply it with the present value factors and then you will get the PVI. Okay, let's do one thing. We'll write it in the column way only. Better. Yes. Year 1, 2, 3, 4, 5. Because you can extend the lines. You cannot extend the rows. Correct? There is a restriction on the sidewise movement, but there is no restriction on the downwards movement in your. There also restriction is there, next page you have to go, but you can still continue, right? Exam, they don't prefer you write in both the sides of one page. Okay, one page means one page itself. You cannot write like this. This is one page. Let's say this is 2 pages. You cannot put the table in both the pages and say here, 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 here. No. The table should come in one page itself, okay? Yes. You cannot shift the orientation and also write. On year. Years are done. So next, below that right now, profit before depreciation and taxes. Year, keep it a little bigger column. Year column, keep it a little bit so that as assigning values or anything is there. Short forms you have to put it, all those things can be attached. From where are we getting these values? PBDT, which working note? Which working note? Working note? 2, yes. Tell me what are the values for year 1. All the years it is same, 1,20,000. Yes, good. From this, what you will minus? Depreciation. Which working note? Which working note? 3. Tell me. First year depreciation. Second year? Third year? Fourth year? 10,000? Fifth year? Nil. Profit before tax. 1,05,000 then. 1,09,000 then. 1,12,200 then. 1,14,760 and 1,25,000. Any doubts until here? What you do next step? Profit after tax you have to compute. So we'll minus the taxes. So can I tell you something here? Listen. Actually, no, we can reduce one step. I have not told it to you till now, but I've explained it to you in a different form. We can actually reduce one of the steps. What we can do is, we don't need to do less tax and write profit after tax. Rather, we can directly write profit after tax. How? Profit after tax is nothing but profit before tax into 1 minus T. Remember when I did the concept of cost of capital, I had explained it to you how after tax and before tax works. So profit after tax is nothing but profit before tax into 1 minus T. So in the previous slide, we have got the profit before tax. That into 1 minus T, we can get the profit after tax. So what happens over here is, we will not lose on marks also. Plus, we will get the answer in a faster manner. Is that clear? Yes? Okay. One less step is a little lesser time spent on the solution. Nothing wrong in writing less tax and then writing profit after tax, but nothing wrong in directly writing also. Is that clear? Yes. Can you tell me what are the values? What is the tax rate of this question? 35%. So how does it work is 1 minus 0.35. How much is that? 0.65. That into profit before tax. What is the profit before tax? 1 lakh? 5,000. Tell me how much is it? 68,250. Next, 1,09,000 into 0.65. How much? 70,850. 1,12,200 into 0.65. 72,930. 1,14,760 into 0.65. That is 74,590. 4, and lastly 1,25,000 into 0.65, that is 81,002. Everyone? Yes? After this, what do? We add the depreciation to get the cash flow after tax. Okay, but can I say we can avoid a step here also? How? We don't need to write add depreciation again. What we can write is directly cash flow after tax, that is profit after tax plus depreciation. Is that clear? Everyone? Yes or no? What is the cash flow after profit after tax first year? 68,250. What is the depreciation of the first year? 20,000. So what you are doing? You are taking this and adding this, correct? Yes. How much? 88,250. Next. 86,850. Next. 85,730. Next. 834. Okay. Next. Same number only, no? 81. 2. Loss on sale of assets should be subtracted before calculating tax for 5th year. We have to do it, but not directly the loss. I'll come to it. Okay? Because that is with respect to terminal cash flows. We consider the terminal cash flows separately, no? That I'll adjust that. Okay? I'll not adjust in the regular cash flows of the business. I'll adjust it in the terminal cash flow computation. Explain the calculation. Which calculation? Oh, profit after tax plus depreciation. What is cash flow after tax? Profit after tax plus depreciation. We are finding the cash flows after tax, right? So to find the cash flows after tax, we need profit after tax plus depreciation. Part is what? Profit before tax into 1 minus T. We had discussed this. If 1 lakh is your profit before tax, less tax at 30%, if you say, it will be 30,000. Profit after tax will be 70,000. Correct? Instead of doing this, we can directly do profit after tax is equal to profit before tax into 1 minus T, that is 1 lakh into 1 minus 0.3. That's all. You will get 70,000. Profit after tax plus depreciation is cash flow after tax. So we have added the depreciation 20,000 to 68,200. For more clarity, if you want, I'll number this 1, 2, 3, 4, 5. Now to arrive at 4, it is 3 into 1 minus t. And to arrive at 5, it is 4 plus 2 depreciation. Is that clear? Everyone? Everyone? Next working note is working note 6. Right. Calculation of. Are we done with working note 5? Are we done? We have to find the present value. Did we find the present value? No, we have only found the cash flows after that. So what is our next step? Right. 6. PVIF at what percent? 20%. Give me the PVIF at 20%. Point 833, then 0.694, 579, no? Then 482, yes. 0.402. Now what you will do last? Step number 7. Present value of cash flows after tax, that is 5 into 6. Everyone. 88,250 into 0.833. 73,000. Enough. 512. Round it off. No problem. Okay. Next. 86,850 into 0.694. 60,274. 73.9 you get. Next. 85,730 into 0.579. 49,638. Next. 40,890. Yes. And lastly, 32,660. What is the total present value of cash flows after tax? Add all of them. How much? 2,56,970. Okay. Go through the table once again. Okay. I know it's a lengthy solution. We are doing it as slow as possible. First, we found out what? Present value of cash outflow, initial, correct? Then we found out profit before depreciation and taxes. Then we found out the depreciation. Then we found out the present value of cash flow after tax. We also found out what is the loss or gain on the sale of asset. These are the things that we have computed till now. Is that clear? One more last working note is there. That is terminal cash flows. Once we are done with that, all the working notes are done. Last calculation will be NPV. Ultimately, in this, we are finding the NPV because we have asked us whether the project is viable or not. So we are finding the NPV in the project. So we are not using any formula specifically over here. It's not any formula based calculation. It's purely an understanding based computation over here. So when it comes to full-fledged question of capital budgeting, three things you have to identify. This also I told you in the last class. First is initial cash flows, subsequent cash flows, and terminal cash flows. So initial means year zero, subsequent means 1, 2, 3, 4, and so on till the end. And terminal means last what is going to happen. That is sale of the asset, recouping the working capital back. That means whatever you have invested in the form of working capital, you can take it back from the business. So that is the last stage. So these three things you have to identify. So to identify these three things, you'll have to figure out what are the information that is given to us in the question. Sometimes direct information would be given, that is PBDT could be given, PAT could be given. One of the questions that we saw in the last class, PAT was given. We added the depreciation, we got the cash flow after tax. Here we started from the base data, that is sales minus variable cost, contribution minus fixed cost, depreciation, then you got the profit before taxes, then minus the taxes, then you added back the depreciation. Now the reason why we did different working notes is until PBDT the data was same. Because depreciation was different for different years, we had to compute the cash flow separately because depreciation will affect the tax computation, which in turn will affect the cash flows after tax calculation, and that is the reason why we did the working note separately. Otherwise, if all the data were same, this would be one working note. We would not have computation of PBDT. We would directly have computation of PV of cash flows after tax, that is subsequent cash flows. We would not have this depreciation calculation also. We would not have this computation of PV, present value of cash flows after tax separately. Only this loss calculation we would have because that is needed in the terminal value. Is that clear? Okay. Alright. Is it clear till here? Yes. Next. Last working note. What is that? Calculation of present value of terminal cash flows. Right on. Calculation of present value of terminal cash flow. YouTube is our choice. Like I want to put it up, so my choice. It'll not. Don't worry. Complete syllabus won't come on YouTube. Someone is saying they thought the YouTube live is going to be only for 2 days. It's happening today also. How does it matter to you? Gracious. There is one more. Remaining portions, will it be done from 7th to 13th? I don't know. We have not yet come to any conclusion on that. By 7th to 13th, you have holiday. 7th September to 13th September, you have holiday. I don't know. I really don't know what you should do. You don't know. You also don't. I don't know. When will it be done? We'll inform you guys. Because I am only not sure when it is going to be done. I have not communicated or, I could not communicate about it yesterday. So let's see today something we can. We'll figure it out. You don't need to worry about it. Yes. Okay, tell me what will you receive in the 5th year? One salvage value, working capital. So these are very good. 2 things right now. Okay, those are the off days. Okay, fine. We'll see. Yes, each question is different. Question cannot be same, no. Each working note is different because of the information that is there in the question. Working note also, there is no format as such. We draw the working notes based on what information we have in the question. So that is what we need to identify. So this chapter is not about a format based calculation. It is based on calculation from the point of view of understanding what elements are there. Okay. Write down particulars and rupees. Right now it is difficult because you don't know how to do it. But once you start solving on your own, you will be able to do it. When you're starting it only, if you tell it is difficult, then you will always have that in your mind. You should never say something is difficult unless and until you try it on your own. And you should never try it unless and until it is completed in the class. So these are two things that we usually end up doing. We try something way early before it is completed in the class. We get scared because we don't know how to do it. Or we tend to think that things are difficult. That's actually not difficult. It's just that the type of questions that is why I have given over here is all different from each other. I cannot give you repeated question and make you feel that you have understood everything in the class. I have to make you feel a little bit uncomfortable to solve. That is where you will revise things on your own. If you feel you know everything in the class, then you will not go back and revise. Okay? And all the questions that can be done in the class cannot be the same. Then I am just making you comfortable. I'm just making you feel what I've done is all understood. That's not the way in which a subject should be taken. I cannot do the same question with another numbers again. I have to do a different question. That is where your understanding increases. And the thing about these type of questions is when I'm solving it, if you're able to understand what I'm doing, then when you're analyzing, if you're able to get to know what should be done, that is where your progress is good. You cannot compare it with the previous topic where I did one question and the remaining three you could do it on your own because it was formula and format based. This is not a format based topic. This is a pure understanding based topic. Now I could have done the working notes here and there. There is no order of the working notes. But if you see, I have done the working notes also in one order itself. First I did initial outflows, then I did subsequent, then in between we computed the loss or profit on sale, correct? And then finally I did the terminal cash flows. Yes, you need to practice. Once I finish this chapter today, you need to practice the question. That is where you will understand because every question will be different from the other. It is not about by hearting certain things over here. It is about the element of understanding what needs to be done. Okay, last working note, calculation of present value of terminal cash flow. Right, first one is working capital recovered, correct? I don't think the ACs are on. Because if it was on, by now we should have got the, I think at least the ones was at least, I believe I would have understood it by now. No, right, it's not on, no? Yes, the offline class is full, actually full. See, what is full is different. How many come to class is different. Okay. As for the data, it is completely jam-packed. I think some of them come on and off. So the academy cannot guarantee you whether you will get placed to sit or not. Okay. For this, what you'll add? Salvage value? Yes. Sale price or salvage value. How much is that? 10,000. Okay. Now listen to me very carefully. Next adjustment is something different in this particular question. You remember there was a loss on sale of asset? Yes? Okay. Now, two things you have to understand. Loss on sale and profit on sale. Now, tell me, if there is a profit on sale of asset, can I say that our revenue will increase? Yes. And when the revenue increases, can I say our tax will also increase? Correct? Listen carefully. When there is a profit on sale, our revenue will increase. And when revenue increases, tax will also increase. Everyone? Okay. So, for example, if the profit on sale of any asset is 5,000, example I am giving you, okay, nowhere related to the question. I am giving you an example. If the profit on sale of asset is 5,000, can I say the tax on this, let us say at 30%, is going to be 5,000 into 30%. How much is that? 1,500. Is that clear? Yes. Can I say that this is the extra tax that is getting paid by the company? Is this understood? Everyone? Yes. Why are they paying this? Because there is a profit on sale of rupees 5,000. Is this clear? Everyone? Yes. Okay. So this is extra tax that needs to be paid. So can I say this is outflow? Yes. Now, when there is profit, the revenue increases. So tax will also increase. Correct? Okay. When there is loss, revenue reduces. So tax will reduce. Correct? So there is tax savings. Is this clear? Yes. So the concept is directly the opposite to each other, whether it is tax benefit or tax payment. If it's a tax benefit, it is considered as inflow. If it's a tax extra payment, it is considered as outflow. Is that clear? So over here, this 1,500 is out. Understood? Now, let us say, if for example, loss on sale is 10,000. Okay. And the tax rate is 30%. So what will be the tax benefit? 3,000. This will be what? Considered as inflow. Why will it be considered as inflow? Is because had this loss not been there, you had to pay extra 3,000. I'll give you a comparison now. Listen. Let us say all the cash flows after tax considering was 1 lakh. Okay. No, we'll take not cash flow after tax. We'll take profit before tax. We'll take. Okay. It was 1 lakh. Two situations. In situation 1, loss on sale of asset was 10,000, and in situation 2, there is no loss. Okay. So from the profit before tax, we will minus the loss on sale of asset. How much you get? 90,000. Here, 1 lakh. Correct? Yes. Let's say taxes is at 30%. 27,000, and here 30,000. See the difference? How much the difference? 3,000. Can I say, since there is a loss of 10,000, you're saving taxes of 3,000? Yes. So that is the benefit that happens when there is loss on sale of asset. Is that clear? Understood? And when there is profit, your revenue increases, your outflow will also increase. Understood? They are exactly opposite concepts of each other. Is that clear? Yes? Okay. Is it clear till here? Yes. Okay. Now in this question, do we have profit or do we have loss? Loss. So what will it be? Tax advantage. Is that clear? Yes. Okay. Right now. Add. Tax benefit or tax advantage on what? Loss of Loss on sale of asset. Loss on sale of asset. How much is the loss on sale of asset? 30,960. Which working note is this calculated in? Working note 4 into, what is the tax rate? 35%. That is 0.35. 30,960 into 0.35. How much is that? 36. Add all of them. 70,830. This is the amount that is received in the last terminal period. Correct? So can I say to find its present value, we have to multiply it with PVIF. What percentage? 20%. For which year? For 5th year. What is that? You already found it here in the previous table. 0.402. You don't need to find it again. It's already there in the previous table. Multiply. Tell me. Point into 0.402. 28,476. That is your PV of cash. 28,470. Is it clear? Finally, computation of net present value. What are the inflows that we have? What are the inflows that we have? We have PV of cash flow after tax. Which working note? 5, no? 5 or 6? 5. For this we will add present value of terminal cash flow, because both are inflows there, correct? Yes. All of them are inflows there. How much is that? Working note 6. What are the values? Can you tell me the values of both? 2,977, and this one is? What is the total PV of cash inflow? 2,85,453, no? From this you will minus present value of cash outflow. Which working note? 1. Yes. How much is that? 1,50,000. One lakh. Correct? Is it clear? No, it's not. Okay. That's not the proper presentation. The presentation is better to show it like this. What add tax? Tax benefit on loss on sale of asset. How is it considered? That is what I explained over here. If there is loss, you get a benefit, and if there is profit, you end up paying tax. This was question number 12, no? Read 13. Try reading 13 on your own. That is to be computed over here, no? This is loss. Working note 4. Fifth year value 40,960. You're selling it for 10,000. So 30,960 is your loss. We have to write a decision or not? Have they asked us decision? Check, check. Have they asked us the decision? Right. What is the decision? What you will say? NPV is positive. So will you accept or reject? Right. Since the NPV of the project is positive, I'll show the working notes. Okay. Since the NPV of the project is positive, the project should be accepted. Sixth working note is here, and then I'll show the last part. For those who have completed, read question number 13. Those who have completed, read the next question. WDV minus the stock value. You're deciding the loss of that. Working, huh? AC? Now working? No. Is it your first day like this? Without AC? Whole power was not done. This is, I think, single phase. Tax benefit. Tax benefit on loss on sale of assets. Yeah. Project equipment sale. No problem. I'll share. Text. We'll discuss about it. Okay. Okay. Are you reading the 13th one? Modern Enterprises Limited is considering the purchase of a new computer system for its research and development division, which would cost rupees 35. The operation maintenance costs, excluding depreciation, are expected to be 7 lakhs per annum. This is the cost. Yes, every year they have to incur 7 lakhs. How much is the cost of the asset? 35 lakhs. Okay. It is estimated that the useful life of the system would be 6 years, at the end of which the disposable value is expected to be rupees 1 lakh. Okay, this is the scrap value of the asset at the end of 6 years. Okay, next. The tangible benefits expected from the system in the form of reduction in design and draftsmanship would cost rupees 12 lakhs per annum. Oh, what does this mean? What does this mean? This particular point. Is it a benefit or is it a cost? Think and answer. Read the sentence again and tell me. Cost reduction or cost savings is equivalent to benefit, correct? Inflow? No, I didn't get you, sorry. Inflow at the initial period, okay. Anyone else? I'm asking you whether it is a benefit or cost. Benefit. What are they saying? Tangible benefits expected from the system. So now you are purchasing a new computer system. So the benefit that is expected from the system in the form of what? Reduction in design and draftsmanship, cost. So cost will reduce. When cost reduces, profit increases, right? So in turn, reduction of cost is nothing but a benefit. Is that clear? Yes. Reduction of cost is also increase in cash flows. In other words, is that understood? I'll repeat again, listen carefully. Any reduction of cost is less outflow. Less outflow means more money in the hands. Is that clear? Yes. So any increase in cost is more outflow. That means increase in outflow. Is this understood? So 12 lakhs over here is nothing but benefit, which can be counted as cash inflow. Is that clear? Next. The disposal of used drawing office equipment and furniture initially is anticipated to be a net of 9 lakhs. What is this? Very good. The salvage of existing whatever equipments and everything the company has. So the company has to spend 35 lakhs for purchasing the new computer system, and whatever old elements that the company had with it, that can be sold for a net of 9 lakhs. Is that clear? Yes. Next. As capital expenditure in research and development, the proposal would attract 100% write-off for tax purposes. Okay. This is something that I will explain in a while. Let it be pending for now. Okay. Next. The gains arising from disposal of used assets may be considered tax-free. So this used asset 9 lakh is there, no? Whatever gains are there, it's considered as tax-free. Any gains arising from any disposal of assets is considered as tax-free. So unlike the previous question where we did loss on sale or profit on sale of asset, that will be not considered over here. Next. The effective tax rate is 35%. The average cost of capital of the company is 12%. Okay, these are simple things. After appropriate analysis of cash flows, advise the company of the financial viability of the proposal, ignore tax on salvage value. They have clearly given in the question that we have to ignore any taxes on salvage value. So no tax benefit or tax payment on salvage value. So basically you don't need to compute loss on sale or profit on sale of asset. Is that clear? Understood? Okay. Read the question once again. One point I have to explain and tell you. How much are you initially incurring? How much? 35 lakhs. Very good. Okay. Now, do you need to spend the 35 lakhs upfront, or you're selling the current assets and getting some current fixed assets and getting some value? 9 lakhs you're getting, correct? Yes. So how much is your ultimate outflow at year 0? 35 minus 9 lakhs, that is 26 lakhs. Is that clear? Everyone? Okay. Next. What is happening in the subsequent years? You have a reduction in cost. How much? 12 lakhs. Yes or no? Reduction in cost is nothing but a benefit. What else is there? What else is there? Do we have any cost to be incurred? Yes. What is that? Yes. Operation and maintenance cost. So your reduction in cost is nothing but inflow 12 lakhs minus 7 lakhs outflow. Net effect is 5 lakhs. Is that clear? Yes. What else? Depreciation. Now, when it comes to depreciation, they have given us a point which says, as capital expenditure in research and development, the proposal would attract 100% write-off for tax purposes. Now, what does this mean? This means that for the purpose of computation of taxes, depreciation will be allowed 100% in the first year itself. 100% write-off. The entire amount of cost of the asset could be written off in the year that it is purchased. That is in the first year itself. Is this understood till here? What is the cost of the asset? 35 lakhs. So what will be the depreciation on the asset? 35 lakhs. Is that clear? So 35 lakhs would be allowed in the first year. Have you understood till here? Everyone? Yes? Okay. Again, I'll just repeat what are the elements that we have understood till now. Cost of the asset? Cost of the asset? 35 lakhs, correct? Salvage value or sale price of existing fixed assets? 9 lakhs. So how much is the PV of outflow? 26 lakhs. Okay. Next. If you invest in this new asset, your cost will reduce by 12 lakhs. But there is an operating and maintenance cost of 7 lakhs. Reduction in cost is increase in cash flow. So 12 lakhs will be saving, but in that you will have to spend 7 lakhs. So net 5 lakhs. Is that clear? Yes, this is what your cash flow before tax. Is that clear? Yes? Okay. We'll come to the depreciation part now. It says in the question that the depreciation is allowed as an expenditure in the first year itself. 100% write-off is nothing but completely written off in the first year. 100% write-off for tax purposes mean written off in the first year itself. So in the first year, 100% of the value of the asset will be provided as depreciation. That means 35 lakhs. Can I say there will be a tax advantage on this? Because the only reason why we provide for depreciation is to check whether the tax benefit on the sale. Did you understand this? Okay. So 35 lakhs is your depreciation element in the first year, which also means remaining years there won't be any depreciation. Is that clear? Which also means the WDV of the asset is 0. If the entire cost is provided as depreciation in the first year itself, 35 minus 35, WDV will be 0. So when you are selling the asset at the end of 5th year, there will be some profit on the sale of asset, which we are ignoring because they have said ignore tax on any salvage value. Is that clear? Had they not given this particular line, then we should have considered the profit on the sale of asset. Is this understood? Okay. So that part. Then how much it can be disposed for? They said at the end of 6th year, 1 lakh. So actually profit should have been computed, but since in the question they have given ignore, we will completely ignore it. Is that clear? Okay, if they had not given ignore, can I say 1 lakh would be your profit on sale of asset? Yes. Did you understand? And 1 lakh, if it was your profit on sale of asset, 1 lakh into 0.35 would be the tax rate, correct? Can I say that much tax you will have to pay? Your outflow will reduce. Is this understood? Okay. Fine. Everyone has understood till here? Why do we take depreciation on? Not 34. See, because we are doing depreciation under SL, not under SLM over here. We are doing it under WD. When they say 100% of the C, as capital expenditure in research and development, the proposal would attract 100% write-off for tax purpose. 100% of what? 100% of the cost of the asset. When they say 20%, on what are you computing the 20%? Last question. It was 20% on WD. 20% on what did we compute? So, whenever percentage is given, it is always on the cost of the asset. Okay. Under SLM method only we do cost minus scrap value divided by number of years. If it is WDV method, we don't consider the scrap value. Is that clear? Yes. Okay. Fine. Any doubts? Okay. You can consider that, but right now your section 35 of the Income Tax Act is not needed. Okay? Yes. I know. Specified businesses, but not needed right now. When you learn it there, those who have done well and good, but those who have not done, it's okay. I'll just explain from the point of view of how to do it for financial management, because if you want to understand section 35, you have to go ahead with all the other elements of PGP also. Okay. Yes. All right. Shall we write the solution? Question number 13. Write down. Okay, now tell me, should we do the working note for initial outflow? Okay, 1. Should we do the working note for cash flows after tax of subsequent years? Yes. Should we do a working note for terminal cash flows? Yes. Okay. Now, listen. There is one thing. In the first year, you have to provide depreciation of 35 lakhs. Correct? Can I say that is not to be provided in the next years? Only in the first year. So, there is a difference between the calculation of the first year and the subsequent years. So, since only one value is different in the first year, that one value I'll show it separately in the working note. I'll repeat again, listen carefully. Okay. So, we have to do 3 working notes. That is for sure. One is present value of outflows, PV of subsequent cash flows after tax, and the third one is PV of terminal cash flows. These are the 3 working notes. Now, when you talk about the first one and the third one, it's pretty basic. But the second one is where 5 years, 6 years data we have to have. All the 6 years, the value remains the same, except for in the first year, when 100% of depreciation is provided, because of which the value of the first year will change. But so to provide for that, I'll not show it in that working note. I'll show it separately in one more working note. There is nothing wrong if you show it over there as well, but you have to show year 1 separately, then the remaining years separately. Instead, we'll do 2 working notes to show purely the depreciation calculation, so that there is clarity in what we have done as well. Is that clear? Everyone? Yes? Okay, write down. Question number? Which question? Sorry, working note. First, calculation of PV of cash out. Particulars, rupees. Below the particulars column, right? Cost of the asset. How much is the cost of the asset? 35 lakhs. Less what? Sale proceeds from what is given? Drawing office equipment and furniture, no? Correct, no? Right, like that one. Sale proceeds from. You can write existing asset, but no one. Let's write it as how it is given in the question. Drawing office equipment and furniture. How much is that? 9 lakhs. So you're spending 35 lakhs, but you're making 9 lakhs by selling the existing assets. So how much is the balance? 26 lakhs. This is the PV of cash out. Second working. PV computation of, right? Computation of PV of cash flows after tax. Computation of PV of cash flow after tax. Single page only. Write down particulars and rupees. We have a reduction in what? What is that? Reduction in cost, correct? Cost of design and craftsmanship. Yes, right. Reduction in cost. How much is that? 12 lakhs. But to have this reduction in cost, we have some operating and maintenance expenses, correct? Reduction in cost is increase in profit. That is, in other words, if your outflow reduces, your inflow will increase. But to have this reduction of 12 lakhs, you have to incur a 7 lakhs. So less. What cost is that? Operation and maintenance cost. How much? 7. Yes. Can I say this is the cost savings? Yes or no? Yes. Right. Cost savings. Is it before tax or after tax? Before. 5 lakhs? Yes. Can I say that? The computation only for the first year is different from the remaining 5 years? We'll do one thing, we'll do all the same for all the 6 years. We'll show the difference in the next working note. Is that clear? Yes. I will not consider the depreciation here. I'll consider the depreciation in the next working note. Is that clear? Yes? Okay. Let's taxes. What is the tax rate? What is the tax rate? 35%. How much is 35% of 5 lakh? 1,75,000. 3,25,000. What is this? This is your cash flow after tax. We are not adding depreciation and all because we have not minus depreciation only. And why have we not minus the depreciation? Because depreciation is provided only in the first year. I am going to show a different calculation for it in the next working note. Is this understood? Very good. Okay. Is CFAT enough or we need to find the PV of CFAT? So into what? Present value interest, annuity factor. Why annuity factor? Because 3,25,000 is the cash flows for every year for the 6 years. Is that clear? Clear? Yes, right on. PVIAF. What percentage? 12%. For how many years? 6 years. How will you compute it? If you have GP in your calculator, directly you can do, correct? How will you do it? 1 by 1.12. How many times equal to? 6 times. GP. What do you get? 4.111. Those who are not getting the answer, please check carefully. 1 by 1.12 equal to, what is it? 0.893 plus next value. What is it? 0.797. What is the next value? 0.712. Fourth year, 0.636, correct? Fifth year, 0.7. And last year is 0.507. When you add all of this, you get 4.111. Small variation may be there. Okay, that's all. Okay, no problem. Is it clear? Clear? Everyone, multiply. Present value of cash flow after tax. How much? 13,36,070. Everyone? Yes? So 2 things done. One more adjustment that we need to make is with respect to depreciation, correct? Yes, right. Third working note. Can you tell me what happens when you charge depreciation? What happens when you charge depreciation? When the value of the asset will reduce. Okay, one more thing. What is the other benefit of depreciation? Tax, correct? So, when you charge depreciation to your profit will reduce, correct? Because of which taxes will reduce. I'll repeat again, listen carefully. When you charge depreciation to your profit will reduce, because of which your taxes will reduce. So can I say depreciation, that is because of depreciation, there is a tax advantage or tax benefit, correct? Yes. That is what we have not provided right now. Is that clear till here? Yes. So, can I say the next working note will be only for tax benefit on depreciation? Now tell me, when is depreciation charged? At the end of first year, correct? Yes. So basically, you start at year 0. At the end of first year, the entire 35 lakhs is charged as depreciation. But are we getting the benefit of depreciation? No. We are only getting tax benefit on depreciation. So tell me, what is the tax benefit on 35 lakhs? 35 lakhs into 35%. How much is that? 12,25,000. Is this here? This is when at the end of first year, we want everything at present value. So can I say you have to discount it by 1 year to get its present value? Is this here? So multiply it with what? What is the PV factor of first year at 12%? 0.893. Got it? Got it? Everyone. Had you done it here, the first year would be separate. The remaining 5 years would be separate. I didn't want to show different calculation because it leads to confusion when you do it in a different form. Is that understood? Since depreciation is charged only in the first year, I did the depreciation calculation separately. And the advantage for us is the tax benefit on depreciation, nothing else. The entire value of depreciation is not your inflow. Depreciation is a non-cash expenditure. We minus it from the profits because our tax is reduced. Reduction of taxes is nothing but increase in inflow. Is that clear? This I have explained to you with examples also clearly. Is this understood? Right now also sometime back I explained how it works. 27,000 and 30,000. Remember? Yes. Tax benefit when profit is there, when loss is there. All this. Oh, so right. Third working note. So first and second are clear. Okay. The extra third one is because of depreciation. Otherwise, this third one would not be there in this particular question right now. Computation of present value of tax benefit on depreciation. Particulars, rupees. Depreciation charge for year 1. How much is it? How much is the depreciation charge for year 1? 35 lakhs. 12 lakh, no. 35 lakhs is the depreciation. 12 lakh 25 is the tax benefit on depreciation. How much is the depreciation? The entire cost of the asset, 35. Given now in the question, 100% is written off. Okay. Next line you write tax benefit on depreciation. How much? 35 lakhs into 0.35. 12 lakh 25,000. Yes. Clear? Into PVIF at 12% for year 1. How much is the PVIF at 12% for year 1? 0.89. So next line you write PV of $12 lakh 25,000 into 0.89. 10 lakh 93,925. Correct? Yes or no?
Yes.
If I would have said depreciation is charged in the second year, then you would have taken the PV factor for second year. That's it. Is that clear? What would that be? 1 divided by 1.12 equal to 0.797. Clear? Understood? They will not, but I'm just asking you. Concept wise, is it clear? In your charge spelling, I wrote it wrong. G, I missed. Charred, I have written. Everyone? Okay. So now listen, what and all we have done. Initial done, subsequent done. In subsequent, we have to do depreciation separately. That is also done. Now what else is remaining? Terminal. Correct? Yes, right now. What? Fourth working note, no? No, So 100% depreciation charge means depreciation will be 100% of the cost of the asset. Write off it is 100% of the cost of the asset is written off. So depreciation for the first year will be 35 lakhs. Next year onwards it's going to be nil. We did only the tax benefit on depreciation. Yes. Because that's the only advantage that we get when there's depreciation. No other advantage we get. Fourth working note, write down. Computation of PV of terminal cash flow. Why are we discounting PVIF at 12% for tax benefit? Because the tax benefit is at the end of first year, no? Depreciation is charged for the first year. So tax benefit is for the end of first year. We want the present value of everything, that is at year 0. So we are taking it back by 1 year and hence we are discounting it by 1 year. What is the next heading I told? Computation of or calculation I told. Anything you write, no problem, okay? Both are nothing but the same. Computation of what? Terminal cash. What is it? Inflow or outflow we have? Inflow we have. How much? Salvage value. What is that? 1 lakh. Yes, that's all. Only that. Do we have recouping working capital? Any working capital that is recovered? No, nothing. Don't assume that working capital is there. If you assume also, what is the amount that you'll assume? No assumption. Leave it. Okay? Not write anything over there. Is that clear? Only if they give you information in the question, we will consider the information. Yes, right. Particulars and rupees. Tell me. Salvage value. How much is the salvage value? 1 lakh. This salvage value you will multiply it with PVIF at 12% for 60 years. Correct. Why 60 years? Because life of the asset is 6 years. What is that? 0.507. That's all right. So PV of terminal cash flow 50,700. Lastly, what you do? What do you do? Computation of NPV. First, figure out what are the benefits. What are the benefits that we have? Present value of cash flows after tax, correct? Yes or no? How much is that? 13 lakh 75. Next, what is the next benefit that we have? No, before that, one more we have. Tax benefit on depreciation. Yes, right. Add. What is it? PV of tax benefit on depreciation. How much is that? 10,93,925. Then what do you add? PV of terminal cash flow. How much? 50,700. From this, what you will minus? Present value of cash. That is 26 lakhs. What? Negative or positive? Negative. Negative you get. 75 plus 1 lakh 19,300. Negative. 1 lakh 19,300. This is your NPV. So what is your decision? Do you want to replace the existing office equipments and all that? No, you will not, because the NPV is negative. What is the decision that they have asked at the end? Advise the company about the viability of the project. What will you say? The project is not financially viable since the NPV of the project is negative. Yes. Decision or recommendation. You can write like that, okay? The project is not financially viable since the NPV is negative. Done? Last line of working note 4. We are adding tax benefit on depreciation because if when you charge depreciation, your profit reduces. When profit reduces, the tax is reduced. And hence when taxes reduces, outflow reduces. In turn, whatever you have, in other words, you can say inflow increases. Outflow reduces is as good as inflow increases. Which working note? Which working note? Two. Okay, 3. When are you charging the depreciation? At the end of year 1, correct? How much is the depreciation? 35 lakhs. What is the benefit on depreciation? Taxes will reduce. How much? 12 lakh 25,000. When is the benefit? At the end of first year. So to get it down to year 0 by discounting it using PVIF at 12. Basically, if you see everywhere this concept of time value of, go to question number 15. What is the doubt in note 2? It said it is written off. 100% written off means the first year itself. That is itself the concept. PVIAF values means all the present value of 6 years put together. First year present value, second year present value, third year, fourth year, fifth year, sixth year. All of them put together is your PVIAF. What if there's a different year? That would be given in the question. Usually depreciation is charged either in the first year or throughout the years. can be given to us a question. If they would have said 100% write off, it means in the first year itself. Otherwise, they would mention WDV, SLM, whatever the case is. If nothing is mentioned, then it is SLM. Guys, if nothing is mentioned with respect to SLM, with respect to depreciation, if nothing is mentioned with respect to depreciation, you do it under SLM method. Cost minus scrap value divided by life. 35 minus 1 divided by 6. But here they have given this charge in the first 100% write-off. That means in the first year itself. Okay. Question number? Which one? Read. Electronics Private Limited is considering a proposal to replace one of its existing machines. Okay. In this connection, the following information is available. The existing machine was purchased 3 years ago for 20 lakhs. It is depreciated 20% per annum or reducing balance basis. WDV. Which one? The existing machine. When was it purchased? 3 years ago. For how much? 20 years. So can I say every year 20% depreciation has been charged? Can you tell me what is the cost of that WDV of the asset today? 20 lakhs was the cost 3 years ago. You have to provide depreciation for 3 years. So can you tell me what is the WDV of the asset for the end of third year? Do you know how to compute? What you will do? 20 lakh you will take in the calculator minus 20%. First year done. Minus 20%. Second year again minus 20%. How much do you get? 10 lakh 24,000. Everyone? I'll put a working note for this. But did you understand this? Yes. So 20 lakhs minus 20% first year depreciation, minus 20% second year depreciation, minus 20% third year depreciation. You get 10 lakh 24,000. Okay, fine. Then it has remaining useful life of 5 years. Which has life? The previous asset has another life of 5 years. But its annual maintenance cost is expected to increase by 1 lakh from the 6th year of its installation. This you have to be very careful. Okay, now see this. I'll put a timeline for a really better understanding of the question. So we are right now at year 0. The machine was purchased 3 years ago. Correct? So it says annual maintenance cost is expected to increase by rupees 1 lakh, not from, okay? From 6th year of its installation means 3 years have passed by, another 3 years. Is this understood? Increase by 1 lakh cost. Here, everyone. Okay. Did you understand this? Next. Its present realizable value is 12, which means if you sell it right now, you will get 12. Is that clear? The company has several machines having 20% depreciation, which in turn is saying you that the block will exist. The block does not cease to exist. Is that clear? Which means tax on loss or profit on sale of asset should be ignored. Not ignored, should not be considered because the block does not cease to exist. There are other assets for which 20% is charged. Is that clear? So the block will continue. Have you understood this? So every question, if you see, we had done different adjustments. Next. The new machine will cost rupees 30 lakhs and is subject to the same rate of depreciation. Okay. So it comes under the same block. Next. On sale after 5 years, it is expected to realize 18 lakhs. So at the end of 5th year, you realize how much? 18 lakhs. With the new machine, the annual operating cost, excluding depreciation, are expected to decrease by 2 lakhs. That means when you purchase the new machine, every year your cost will reduce by 2 lakhs. Okay. In addition, the machine would increase productivity, on account of which net revenues would increase by 3 lakhs. So if you see over here, they have given you how much is the increase and decrease, correct? So they have not given us the total values, they have only given us the incremental value. So we are going to do a new approach here called as the incremental approach. Is that clear? Okay. Next. So what they have said is, if you purchase the new machine, your revenues will increase by 3 lakhs. Okay. Your costs are expected to be reduced by 2 lakhs. Increase in revenue is increase in cash flows. Reduction in cost is also increase in cash flows. Correct? Read the sentence again. From here, with the new machine, the annual operating costs are expected to decrease by 2 lakhs. Costs are reducing means profit will increase, cash flow will increase, less money is flowing out. Is that clear? Next, in addition, the machine would increase productivity, on account of which net revenues would increase by 3 lakhs. Increase in revenue, cash flow will increase. The tax rate applicable to the company is 40% and the cost of capital is 10%. Is the proposal financially viable? Advise the company on the basis of NPV of the proposal. Present value factors at 10% is given to us. We don't need to compute it separately on our own. Is that clear? I told you this in the previous sessions also. Whenever PV factors are given, we'll take it as per the question itself. We're not going to question the question. If they give 2 decimals, we'll take 2. If they give 4, we'll take 4. We have done one question where they are given 4. That EM and LM question, EAC question, equated annual cost. Okay, fine. Now, we have an existing asset. Yes. Whose cost 3 years ago we know. We don't know its WDV today. We have to figure out its WDV today. That is first step. Okay, correct? Yes. That asset is getting sold and a new asset is replacing that asset. What is the cost of the new asset? 30 lakhs. 30 lakhs? Sure? Okay, fine. Then what else is there? How much is the asset getting sold for? How much is the asset getting sold for? 80 lakhs. Is it clear till here? Yes. So how much is the new asset being purchased for? 30 lakhs. How much is the old asset getting sold for? 80. 12 lakhs, no? 12 lakhs. So net outflow is 80 lakhs. Is that clear till here? Yes or no? Okay, next. On sale after 5 years, it is expected to realize 18 lakhs. That is at the end of 5th year. That we don't want. That is terminal values. Okay. Oh. Now, every year, what happens to your revenues? It will increase by 3 lakhs and your cost will reduce by 2 lakhs. So net benefit is 5 lakhs every year for remaining 5 years. Tax rate is given, cost of capital, PE factors, everything is given to us in the question. This particular question does not follow the total approach, it follows the incremental approach. So we cannot do total depreciation, we have to do the incremental depreciation. That is, what would be the depreciation had the old asset been there and what would be the depreciation with the new asset. The difference between that is what we need to compute. Why are we doing incremental computation here? Because the data given is incremental data. They have not given us the total data. Is that clear? Had they given us the total data, we would have compared total directly. Yes? Or if you remember in one of the questions that we had done, we had profit after tax. Correct? For the profit after tax, we added the depreciation of the old machine and the new machine, and then we did incremental cash flow after tax. Here, directly you have to do incremental, you cannot add it to anything because you don't have the profit after tax individually. Is this clear? And 1. Yes, first working note is very basic. That is WDV of the existing asset. Right. Right. WDV of WDV of existing asset. Right. Yeah. New type of sound today. Right. WDV of existing asset. This is working note 1. Computation of WDV of existing machine. Particulars and rupees, right? Opening balance. How much? How much is the opening value of the existing machine? 20 lakhs. Less depreciation at 20% for year 1. Right? How much? Written down value year 1 16 lakhs. Less depreciation at 20%. 3 lakh 20,000. How much? 12 lakh? 80,000. That is WDV for year 2. Less depreciation at 20% for year 3. 2 lakh 56,000. WDV for year 10 lakh 24,000. Is it clear? Everyone? Is this clear or not? Clear? Any doubts until here? Did you understand how to calculate the WDV of the existing machine? Any doubts? No. Okay. Can we compute the present value of cash outflow? Yes. How much are we spending on the new asset? 30 lakhs? Yes. How much is the value of the old asset? No. How much are you realizing from the sale of old asset? 12 lakhs. Can I say PV of cash outflow is 18 lakhs? Right. Second one. Computation of free of cash out. Cost of the new machine, particulars and rupees, right? Cost of the new machine, how much? 30 lakhs less realizable value of existing machine. How much? 12 lakhs, no? So that is 18 lakhs. Any doubts until here? Okay. Now, listen carefully to what I am saying. Three things you have to understand here. One is, if the existing machine runs, for the existing machine from 6th year onwards, there will be an increase in cost. For existing machine, 6th year means for us it is 3rd year. So from the 3rd year onwards for us, there will be an increase in 3rd, 4th, 5th year. How much is the increase in cost? 1 lakh. Correct? So that is one thing. Second, if the new machine is installed, can I say there will be a reduction in cost? Yes. How much is the reduction in cost? 2 lakhs every year. Is that clear? And also there's an increment in revenue. How much is that? 3 lakhs every year. Everyone. Now listen to me even carefully. Increase in revenue is 3 lakhs every year. Very clear. Increase in revenue is increase in cash flow. Reduction in cost is 2 lakhs every year. Reduction in cost is nothing but increase in cash flows. Okay. Now, if old asset was there, can I say 1 lakh cost should have been incurred from 3rd year onwards? If old asset was there, can I say that there would be a cost of 1 lakh that need to have been incurred from 3rd year onward? Can I say, if you are replacing the old asset with the new asset, that 1 lakh cost can be avoided? Yes, that is nothing but reduction in cost. Increase in is this. So 3 things that affect the cash. One is reduction in, one more is increase in revenue, or both of existing assets. Both of new assets. And one more is reduction of cost in case the old asset is replaced with new asset. Is that clear? Everyone, this is something that you need to understand. So basically, if the old asset was there, 3rd year, 4th year, 5th year, extra 1 lakh should have been incurred, which can be avoided if the old asset is replaced with the new asset. Is that clear? Everyone? Okay. Fine. Now, one more very important adjustment is with respect to depreciation. Okay. What is the cost of the new asset? How much? 30 lakhs. Okay. What is the cost of the old asset? 20 lakh was the cost 3 years ago. Today's cost, WDV, 10 lakh 24,000. Oh, fine. Now, here what we need to get clear is on what value should we compute the depreciation. On what value should we compute the depreciation? Okay, that is one thing that we need to get it right, for which I need to give you a detailed explanation, right? And it's already almost 10 o'clock. I know you're sitting with a lot of difficulty. I can understand that. So we'll take a break and we will come back. So remaining part, that little complicated part of the question, I do it post the break. Hopefully by that time, power is also hopefully. Okay, we'll see. Uh, if you have to attend college early, you have to inform the team with respect to the attendance. For me, the timings to show the attendance is anywhere between the timings of the class. It's like 12:15 and all, I can show the attendance. Before that, it becomes difficult. So we inform the team that you will be in the class early. They will tell you what is the solution for it. Okay? Power came for some time, huh? Who? These two. They sit out only. Yes. Yes, shall we continue? I know it's difficult. It's better no, now. That's not even I felt. No, not better. No fan at all. Not switched on. This side no fan also. You can actually sit here. Here you can. The first, second bench. Second, no one is here. We'll actually come and sit in the second bench here this side. There's no one. Yes, read the question. And I just opened the book and I didn't realize. I went out for lunch because it was morning. Last 2 days I was sitting in front gates. I'm not going to book anymore.
Oh, yes.
Today just waiting. I'll see till what time I can.
Negligence or possibility. The power was started yesterday. The naming that was happening around 5:30.
Figured it out.
They were scrolling. I got right to the mail. They sit in front of me. 5:56. Until students have to sit on a sweater.
We are some of them are like we go home, we go to Trichy. Some of them come from so far away. You think it's easy to do that? It's easy to tell your just okay, for me, I think it's how I can manage. For these students sitting in this corner of the class is very difficult. Let's see whatever I can take, I take.
Yeah,
Not, I don't think so. I can also. Already it's burning.
or you can arrange the class in the evening. Whoever wants to.
Correct.
2 to 4 will arrange in some other class.
Yeah, something like that. Not today. Tomorrow we can try it. Well, I spoke to them. We'll manage.
Yeah, yeah, something like that.
I'll talk to you later. Yes, shall we? We have to continue the solution. Correct? Question number. Class is till 12:30 or 1 p.m. ma'am. Class may stop before 12:30 also. Who knows? Depends on whether class can be taken here or not. Because as the time passes by now, I think it will be getting hotter and we'll see till it's possible for both the ends. We'll take up the class. If not, we'll stop the class. That's all I can. That's all in my hands. The power issues are not in my control, so I can't do anything with respect to. Okay. I know you will say, ma'am, leaving the class early is in your control, ma'am. Leave the class early. So this power issue is there from yesterday evening itself, not today. Yesterday evening. Fluctuations. Okay. See, now if we discuss on the fluctuations, it's not going to change. Okay? Let us discuss on the question. Which approach are we following here? We are following the incremental. Enough. We are following which approach over here? We are following the incremental approach. Okay. Now, what you need to understand here is the cost of the new machine is 30 lakhs. The realizable value of the old machine is 12 lakhs. Correct? Yes. So from 30 lakhs, if you minus 12 lakhs, you get 18 lakhs. Correct? 18 lakhs is your PV of cash outflow. And on that value itself, you will be computing what? Your incremental depreciation. Is that clear? I'll repeat, listen carefully. Please listen carefully. It's a little different from what we have done till now. Usually what we would have done, we would have computed depreciation on 30 lakhs, the cost, correct? Yes. But here, when you purchase the new asset, you are selling another old asset, correct? Yes. So your net outflow reduces, yes, to 18 lakhs. Had you done the approach where you take the depreciation of the new asset separately and the depreciation of the old asset separately, we would have computed depreciation on 30 lakhs and depreciation on the value of the old asset and gone ahead and differential we would have written. But here we are not following that approach because as per the concept of block of assets, depreciation will be provided only on the incremental values. So that is 30 minus 12, which is 18 lakhs. Is that clear? Yes, everyone. 30 lakhs is the cost of the new asset. 18 lakhs is what is the sale price of the old asset. So 30 minus 12 is 18 lakhs. So depreciation will be calculated on how much? 18 lakhs. Is that clear? Everyone? Yes. Okay. I have also explained with respect to revenue to you. That is incremental revenues and reduction in cost. There are three elements. One, increment revenue, and two, reduction in cost. One with respect to the new machine and one more with respect to the savings in cost because of old machine. Is that clear? Yes, that will be the next working one. Right now what we'll do is we'll write the incremental depreciation which will be calculated on the 18 lakhs. Is that understood? Yes? Okay, right. Working note 3. Working note 3. Computation of incremental depreciation. computation of incremental depreciation. Right, year, incremental depreciation, WDV, 3 columns. Doubts with respect to previous questions, I'll solve it once I finish this question, okay? Computation of incremental depreciation. Right, year, 1, 2, 3, 4, 5. Next column, incremental depreciation. And next column, stop talking, closing, WD. How much is the incremental depreciation for year 1? Correct. 18 lakhs into 20%. 3 lakh 60,000 minus equal to you'll get the closing WDV 14 lakh 40 into 20%, 2 lakh minus equal to 11 lakh 52,000 into 20%, 2 lakh 30,000 minus equal to 9 lakh 21,000. Again into 20%, if you do 1 lakh 320 minus equal to 7 lakh 37,000. Again into 20% is 1 lakh 47,456. What is the balance? 820. Clear? Yes. Any doubts until here? Everyone? Can I go ahead to the next table? Yes, right, 4th one. Computation of present value of incremental cash flows after tax. Present value of incremental cash flows after tax. Okay. Let me do the table first. Okay. You listen carefully. Then I'll give you time to copy it down. Listen. How many years in total? 1, 2, 3, 4, 5. I'll write it like this. Okay. So we can extend it how much ever is needed. Okay. 3 types of incremental values are there. One we have is incremental revenue. Okay. One more we have is reduction in cost, which is again incremental benefits. That is cash flow. One more is again reduction in cost of the existing asset, which is again an incremental revenue. Is that clear? Okay. So first we'll write reduction in cost. I'll write it. You just listen carefully. Reduction in cost of what? New machine. New. Okay. How much is the reduction in cost of the new machine? 2 lakhs. So 2 lakhs. All the years 2 lakhs. No? Now you may be feeling, why am I writing this separately? Why didn't I write it at once only? Because the depreciation of all the years are different. That is why I have written it separately. We could have done one table where it says that calculation of incremental profit before tax, depreciation and tax, and you would have done minus depreciation minus tax and depreciation. That also is possible. That is what I am telling you. There is no one format to solve the question in capital budgeting. NPV questions. You do it how you understand the question. Is that clear? So that is why I have given you different ways to solve in different questions, and I am telling you that alternatively this is also possible. Like for example, in this question, PBDT, profit before depreciation and taxes, is same for all the years. So we would have done one table there and then written present value of cash flows after tax in the next table. That was also possible because the difference arises because of different depreciation values every year. Got it? Okay. Next. Reduction in cost, old asset, correct? Yes, the old asset we have to incur 1 lakh extra from 6th year. 6th year of the old asset is 3rd year for us. Yes or no? Because 3 years have already passed by for the old asset. So from 3rd year, that is 1 lakh, 1 lakh, and again 1. Here nil and nil. Is this clear? Everyone, if you want, I'll write it here. From 6th year for olds. Everyone? Yes. Next. What else do we have? Increase in revenue. How much is that? 3 lakhs all the years, correct? So here we couldn't do one table for PBDT because the cash flows are different for different years. We could have done for year 1 and year 2. We could have done for 3, 4 and 5. But we cannot do it for once and for all. So it's better we do it separately. And last year also 3 lakhs. Yes. Is this clear till here? Yes. Everyone has understood till here. Add all 3. Why are we adding all of them? Because they are our incremental cash flows. Reduction in cost or increase in revenue, both are incremental cash flows. Is this clear? Yes, everyone? Okay. But this is your cash flow before tax or profit before depreciation and taxes or incremental profit before depreciation and taxes. Is that clear? Yes. Okay. So incremental profit before depreciation and taxes. Working capital adjustment? No, working capital adjustment will come here. This table, PV of cash out, will come in this table. You don't need to worry about it. But one thing that you need to understand is for depreciation base, it will not be including working capital. It will only be the additional value of the asset. Got it? Suppose 1 lakh is the working capital over here. So PV of cash outflow will increase by 1 lakh. It will become 19 lakhs. But while calculating the incremental depreciation, you will calculate it on 18 lakhs itself, not on 19 lakhs. Because working capital, you don't compute depreciation on it. Okay. How much is it? Tell me the values. First year, second year, third year, fourth year, and fifth year. Any doubts until here? From this, what you will minus? Incremental depreciation. You have written the table, no? Tell me the values. First value, 3,60,000. Second value, 2,88,000. Next. Sorry? 2,30,400. Correct? Next. 320. And last year, 47. 450. What do you get? Incremental profit before tax. Correct? Yes. What are the values? Tell me. 1,40,000. Then 2,12,000. Next. 3,69,600. No? Check. Compute. What are you doing? 3,69,600. Then 680, correct. Then 4 lakh 3, no? This is 6, tell them. 4 lakh 52,540. Everyone, from this what will minus? Tax. Should we minus tax and write again one more step? No, we can directly write incremental profit after tax. How we write incremental profit after tax? Profit before tax into 1 minus everyone. Yes. What is the tax rate? 40%. So 0.6, correct? Yes, multiply and tell. 1,40,000 into 0.6. 84,000. Next. 2,12,000 into 0.6. 1,27,000. 369,300 into 0.6. 2,760. Next. 4,15,680 into 0.6. 2,49,000. 4 not 8. Yes. Lastly. 2,71,520. 6.4 you get, round it off to 0.6 only, not point you can ignore. Because point is less than 5, so keep it at 6. If it's 5 or more, you would take it to 7. That's it. Is that clear? You don't need to write it in decimals. It will be a lengthy calculation if you sit and write in decimals. Especially amounts when you have in decimals you can ignore, provided it is amounts in rupees, not in lakhs. If you're writing this in lakhs, then 2 decimals are needed. Is that clear? Next. What do we do next? Add depreciation. So you get cash flow after tax. That is incremental profit after tax plus incremental depreciation. Can I directly do it? Or should we write plus depreciation and then write one more step? Not needed. Shall we do it directly? Yes, tell me. 4,44,000. Yes. 4,15,200. 100. I'll write it properly. Just a second. 4,44,000, no? Then 4,15,200. Then 5 lakh, no? How much? 4 lakh? 52,160. Then 4 lakh? 720. And lastly, you have no depreciation value here. 4 lakh? 982. What did we do? We added cash flow, that is profit after tax, with the depreciation to get the cash flow after. Is that clear? We have done this in one more previous question. Yes, same calculation we had done. Yes. So we got the cash flows after tax. Now we need to find the present value of the cash flows after tax, which means we need to find the present value interest factors. Which rate? 10%. Do we write the PV factors or is it given to us in the question? Given to us in the question. So we don't need to put the efforts of finding out the PV factors. Tell me what are the PV factors given in the question? 0.909, correct? Point, yes, 0.751, point 0 only they have given. No problem. You take however they have given. You don't need to worry about rounding off and all over here. Is that clear? Yes. Multiply them. PV of cash flows after tax. Yes, tell me. 4 lakh? 1 second. 4 lakh 3,596. Yes, then 3,42,955. Next. 3,39,572. Yes, next. 2,96,236. No. And lastly, 259,760 total. Sixteen lakh 42,120. I hope you did M plus, M plus, M plus. And then finally, MRC. Is this clear? Table clear? Yes? Okay, write it. Scroll. Which part? Huh? But I told you not to write it down. I told you I'll give you time to write. I think many of them have not written it. I'll scroll it. Can I scroll? If you're not able to understand any numbers written, just ask. Whichever line. If you want, I'll number it. Just a second. I'll number it once. Just tell me which line you're not able to understand the elements so that I can give you a explanation. See, when it comes to capital budgeting, you will find that the solution is lengthy. But once you understand how to do it, it's not difficult to solve. It's just a matter of understanding what is given to us in the question, identifying what is happening at what point of time. At year 0, what is happening? Subsequent years, what is happening? And terminal year, what is going to happen? If you realize these three things, you will be able to get the elements. And remember, whenever marks are allotted to you, it is not based on whether final answer is correct or not. It is based on stepwise calculation. So in a 7-mark question, if half of your answer is correct, maybe the other half you have gone wrong somewhere, you will not get 0. You will still get some marks allocated to that part which is correct. So it is not like they'll check the final answer and then they'll come to a conclusion whether it is correct or wrong. It's a stepwise marking that you're going to achieve in the exams. Point number 5 is done. Yes. Point number 5, from where have you taken the values? Working on? So initial outflow is done. Subsequent cash flows are done. Right? Now we only need the terminal cash inflows. Can you read the question and tell me what is the terminal cash inflow? How much is that? See, the presentation in the table can be in the way I have written, or it can be year 1, year 2, year 3, year 4, year 5. You can write it side by side also. There is no format for presentation. Just that when you write things down, it should be very clear. It's online, some of you were having doubts as to how do we identify what is given in the question. What is given in the question, how do we know what we are supposed to do? Are you able to get an idea now? Wait one. Can you take screenshots? Can you take screenshots in the online? Allowed now? No, previously it was not allowed. So now online class you can take. No. Recorded you can't take, but right now when you're in the online class you can take. Oh. So previously our students used to tell that also screenshots were not. Okay. Oh, if you're logging through Zoom, you can take. Zoom will allow. The ArivuPro, your platform is not allowing. Or you can take pictures. If you're watching on laptop, you can take pictures. Right? On your phone. It will be very close to you all, you know. So difficult to stay without phone. They are slightly complicated. I will not say they are not. Okay. Done? Is it done? Yes. Fourth one is this. You can take a screenshot with it. Write down fifth working on computation of. Write down the fifth working on computation of present value of terminal cash flow. Video is breaking. It's zoomed out. Yeah, that is only for screenshot. I will zoom in now, not that. Yes. Right, computation of working on 5. Right now, computation of present value of terminal cash flows. What is the terminal cash flow? 18 lakhs into PV factor at 12% for which year? 5th year, not 6th year. 6th year was previous question. Here it was 5th year, right? Terminal value is, write particulars and rupees into PVIF at 12% for 6th year. What is the PVIF at 6th year? 5th year. What is the PVIF of 5th year? 0.620, correct? So present value of terminal cash 11 lakh. Last one. Computation of NP. Are you finding some fluctuation in the TV? Like the brightness of the TV is increasing, reducing, something like that is happening in the TV? Because here I am finding that the brightness of the iPad is like fluctuating. Yes. Which up? It's because of auto brightness, no? It didn't happen. Is it on auto brightness? How do I realize? Huh? Brightness is completely full, no? Yellow is there, means it's on auto. I think. No. No, it's not changing. It's not on auto brightness. Okay, anyway. I don't play later. Computation of NPV, right now. PV of cash flows after tax. Which working note? At 10 now, not 12. You gave me the PV correctly only, no? You gave it because table was there. True tone. That is auto brightness. No, that will change the tone of the. That is not. Okay. Enough. Don't want. Full argument will happen now. Sorry, wrong question. 16,42,128. Correct. For this, you will add the present value of terminal cash flow. How much is that? 11 lakh. 16,000 less 11 lakh 16,000 is there in which working note? 5. And lastly, less PV of cash outflow. Working note? Which working note? Working note? How much? Yes, total it up. 1642 128 plus 11 lakh 16,000 minus 18 lakhs. 9 lakh 9,58,120. I don't think auto brightness. I think it's because of the fluctuations of the power that the it's fluctuating a bit. I don't. True tone is adaptive brightness. But okay, I'll ask you something. Now I'm not changing the orientation of the iPad. I'm keeping it in the same place. Then how the brightness can increase and reduce? So that means it's not proper. Light is fluctuating, you're saying. Okay, too much unnecessary discussion. Camera will sense the brightness, sir. Hey, camera is different. This. Okay. Attendance before 11:30. I don't know. Oh, my face is bright, so it will change the brightness. I've only seen iPad in the showroom. Same at your age, even I had seen iPad only in the showroom. Always wanted to buy one. It happened in due course. Like, everything you cannot get at one point of time in your. Some things you will want when you are younger. As and when you grow older, you will realize that you can purchase it. You can buy it. Yes, you will buy. No problem. Yes, can I go ahead? What is the decision here? Should we replace the existing machine? So write the decision. I think when you are doing your articleship, internship itself, you can find. Yes. Because iPad will cost you what? 30,000. Yes. Your internship, you will nicely earn more than that in a span of the number of months that you're putting your internship for. Maybe 3-4 months only, you learn so much. Internship, not after clearing your finals. I'm telling you, before you clear your, I hope you know you have to do something called as articleship or internship, right? Oh. So when you do that only, you will be able to purchase. You don't need to worry. But you have to purchase only if there's a need for it. Unnecessarily, you should not purchase anything just because you can. What is the need of an iPad? That is also needed, no? You don't like iOS. Okay. You're telling to a person who likes iOS. So I don't have any comments for that. I would never go back to an Android. I know people have their own opinions, but not me. I will never go back to an Android because I know that at whatever level my phone, like the data of my phone is not going to hang. In an Android, after a certain point of time, the phone starts to hang. That is what I have experienced. I know things might have changed over a period of time, but I don't want to. Yes. Once you get used to iOS, there is no going back to. It's very difficult. To get used to it also is a little tricky. Yes, can I go ahead? We have one concept that is adjusted NPV. Yes. Nothing is perfect. We are also not perfect. It's a personal choice, right? At the end of the day, I mean, something good for me may not be good for you. It's completely a personal choice. Mark. One last concept is there, that's the concept of adjusted NP. Done. Then we will start with the next. I know you were thinking, then we leave the class. You can sit, no? No. Difficult. For a little time. Attendance mark, leaving class, bye. Attendance screen is not visible. How come? Should be visible. It's visible, see properly. How is that possible? You will exit and join back. Some issue may be there for you. What happened? Time mark. What 22 seconds? No. It will restart again. So the same QR will not work. QR is changed. Attendance will get restart. Now see, within a span of 6 seconds, if you mark this, it will get marked. Now it changed. The QR is changed. So only if this is open, only then you will be able to. Can we see easy chapter after completing capital budgeting? Yes. It's an easier topic as compared to capital budgeting. Next topic is easier as compared to capital budgeting. Yeah, it is capital structure, leverage and dividend both. All the together. Module 4. 2 questions will be asked. If we are not done now, hello. Where you are going to module 4? Checking. I hope attendance is done. Everyone, attendance. No. Mark. Yes. See, screen is visible here. If screen is not visible for you, then you will have to check it out for your. My hand is okay. It's burning right now because there is no AC over here, but manage. OM and SM many insights. I'll give later. Here, my insights only. I am not finishing. Yes. Adjusted. I'll give. Adjusted. How much I know I can give, not more than that. Adjusted net present value. Now listen. Listen. Simple. Not anything difficult. This is a small change in the understanding of the element. So in adjusted NPV, what we do is we consider the project as an all equity finance project. So when I say we consider the project as an all equity finance project, the discounting factor will be KE, not KO. I'll repeat, listen. in the adjusted present value concept, what we do is we consider the project as an all equity finance project. All equity finance project means what? The cost of equity is nothing but the overall cost of capital. So irrespective of whether debt is taken or not, preference share is there or not, we consider, that is, we assume it to be an all equity project. So we will discount the cash flows using KE, not KO. Is that clear? Yes, that is when we get the base case NPV. So first step is to compute the base case NPV. How do we compute the base case NPV? Is by considering the project as an all equity project. That is discounting the cash flows using the cost of equity. Is that clear? Okay. Then after that, we add, okay, whatever benefits we have because of debt financing. And remind us whatever costs are associated with debt and equity both financing. For example, there is something called as flotation cost, which is nothing but an expense. Those things should be subtracted. So basically, I'll tell you the 4 things you have to do. 1, you have to consider the cash flows after tax, discount it using cost of equity. That is your base case NPV. You add any benefit and subtract any cost. You will get the answer for adjusted present value. Is that clear? Yes. Okay. For determining NPV, weighted average cost of capital is used as discounting factor, WAC, based on the assumption that every project is financed by the same proportion of debt and equity mix found in the capital structure of the firm. So what we need to understand here is, when you are discounting any project with KO, you take the assumption that whatever is your capital structure, the same proportion is financed in the project. So what it means in a form of example, if I have to give you, see, let us say there is a company A. Okay. Company A has taken equity share capital of 10 lakhs. Okay. And they have taken debt capital of 5 lakhs. Company A is doing 2 types of project, project 1 and project 2. Project 1 needs total finance of, let us say, 10 lakhs. And project 2 requires a total finance of, let us say, remaining 5 lakhs. Okay, that is why it has taken 15 lakhs. Now, KO assumes that is your weighted average cost of capital, assumes that this 10 lakhs is financed in the same proportion of equity and debt. Got it? Yes or no? That is in what ratio? 2:1 ratio. Is that clear? 2 parts equity, 1 part debt. But that may not be the case. So in some projects, high debt can be there as compared to equity. In some projects, high equity can be there in comparison to debt. Is that clear? Yes, everyone? Okay. So that is why it is told over here, that is the assumption that every project is financed at the same proportion of debt and equity as found in the capital structure of the firm. However, that may not be true. Moreover, tax advantages, that is savings in tax due to use of borrowed fund, is usually not considered in financial appraisal of investment proposal discussed so far. But impact of debt financing can be incorporated using adjusted present value method, the adjustment of tax aspects of debt financing with the base case NPV. So, base case NPV is the NPV under the assumption that the project is all equity financed. Adjusted NPV is base case NPV plus net present value of tax shield arising of financing decisions associated with that particular project. Now, to understand what this NPV of tax shields is, we have to do the question. One example also, if I tell you, you'll understand. So now let's say, for example, we have borrowed a loan of 5 lakhs. Okay. The interest rate on the loan is 10%. So what is the interest payment on the loan? 50,000. 5 lakh is the loan amount. 50,000 will be the interest payment. Can I say because of this 50,000, your profit will reduce? Because of reduction in profit, your tax will also reduce, correct? So that is nothing but your tax savings. Present value of tax savings is nothing but tax savings of year 1 got to year 0, tax savings of year 2 got to year 0, and so on. Total it up, you will get the tax savings, tax sheets basically. You add it up, you will add it with the base case NPV. Is that clear? Yes? Oh, I know there may be some doubts how to solve this and everything, which you will understand when we solve the question. So come to question number 8. When will the class get over? Even I don't know. Will inform. For this slot, 25th is my last class because 26th a new subject will begin for you. Okay. And then we'll see what when can we conduct the next session of the class. Will be updated to you. Even we have not yet figured it out because it happened not out of choice, right? Otherwise, yesterday and day before yesterday you would have class. So it happened out of uncontrollable reasons. Maybe controllable if I was a little more careful, but happens. It's not like I deliberately put the water, hot water on my hand from the cooker. It happened. I can't help it now. Yes. And there's no point in telling you have to be careful and all. Sometimes things happen. It's not in your control. Like after it happened, I was like, what did I do? Sometimes it can so happen that you go blank for a minute or so, right? So I don't exactly remember what exactly. I just know that the water from the cooker fell on my hand. The boiling water fell on my hand. That's all I remember. Then I put my hand under running water. Somewhere I had read recently in ChatGPT when I was reading something, don't put ice. If you put ice, it will increase its seems. I don't know how true it is. So thinking that, I was like, I kept my hand under running water. Okay. Then I went to the hospital. One time, here cooker didn't blast. Mistake was mine only. I only opened the cooker. Yes. Maybe I removed the whistle and opened it. So maybe I opened it a little sooner. Now what has happened has happened. I can't go back. So, it's a lesson to be learned. For you also, for me also. That be a little careful when you're cooking. I know most of you are not cooking, but whenever you cook, be a little careful. I'll show the attendance at the end of the class. Okay, it's still open, you can mark it. I have not closed the attendance. You can mark it at the end of the class. Today we'll see, till we can, we'll push the class. Yes. Any extra will be there. Today, if I take extra, these people will not let me go home. Then you'll have to search for me. They are like, leave now only. If I leave now also, they'll be very... But life is not always about making you happy. So read question number 8. A firm is considering the project requiring 50 lakhs of investment. Expected cash flow is 10 lakhs per annum for 8 years. So this project will run for how many years? The rate of return required by equity invested from the project is 15%. This is your KE. The firm is able to raise 24 lakhs of debt finance carrying 14% interest for the project. That means out of the 50 lakhs, 24 lakhs is through debt and remaining 26 lakhs is through equity. Okay, till here everyone? Okay, let me write it here on. Total finance 50. In that, how much is debt? 24 lakhs. Balance is equity 26 lakhs. Everyone? Yes. Expected cash flow is 10 lakhs per annum. Okay, that is fine. Debt is carrying what interest rate? 14% interest rate. Okay. The debt is repayable in equal annual installments over 8 years period. The first to be paid at the end of the first year. That means every year equal installments are paid. That means 24 lakhs divided by 8. 8 years, no? Yes, 24 lakhs divided by 8. Is this clear till here? 3 lakhs is paid. Is this understood? Everyone. Repayable in equal installments. Repayment of the debt is in equal installments. Repayment is of principal, not interest. Is that understood? Huh. Repayment in equal installments means repayment is with respect to the principal. So every year, a part of the debt is getting redeemed. Do you remember one value of bond question that we had done in cost of capital? Amortization of bond, where we found the value of the bond. There also we had amortized the bond over a life of the asset, where we said every year a part of the value of the bond is redeemed. Is that clear? So in other words, 24 lakhs is the capital minus 3 lakhs. Second year interest will be on 21 lakhs. Minus 3 lakhs, third year interest will be on 18 lakhs. We'll do a table for it. Is that clear? Yes. So like that you will get the interest on debt into PV factors. You get the present value of interest on debt. Is that clear to you? Okay. Next. The tax rate is 40%. You are required to calculate adjusted NPV. Assume equity cost is 5%. This equity cost is 5% is nothing but not the expectation of shareholders that is given over here. This equity cost is 5% means flotation cost to issue equity shares is 5%. Because 2 KE cannot be there. So it is very clearly given over here that the cost of equity is how much? 15%. So anything else with respect to equity given, that is cost given, is nothing but the flotation cost. Is this understood? Everyone? Clear? Clear or not? Okay. Cash flow after tax is there or before tax is there? After tax or before tax? Before tax is there? No, I'm asking you, you tell me. Read the question once again. How do you know it is before tax? Not mentioned. So you'll assume it to be before tax. Did I say anything like that? No, I'm asking you. Oh, we are saying before, because tax rate is given like that. That assumption you cannot. Huh. Correct. Cash flow means what? Cash flow means what? After you add back depreciation, correct? Yes. Now, if you say this is before tax, do you know how to calculate depreciation? No, we cannot, correct? Can we? We cannot. So, we have to add back depreciation. Then you have to minus tax. Then you have to add depreciation back. So, we cannot do all that because there is no clear information on all that. So, we need to understand that cash flow here means cash flow after tax. Is this clear? So, anytime they give cash flow, you take it as after tax unless and until they mention that it is before. Is that understood? How much is the cash flow after tax? 10 lakhs every year. For how many years? 8 years, correct? Oh, now listen to me carefully. Please listen carefully. All the cash flows are discounted at cost of capital usually, correct? But in this adjusted NPV question, what do? We discount the cash flows using K. Okay. Are the cash flows going to remain the same for all the years? Yes, they are the same, no, for all the 8 years, right? So can I say you can directly do 10 lakhs into PVIAF at what percentage? 15% for 8 years. Is this clear till here? Clear? Yes? Shall we write the first note? Right now. Question number? Which question? How to find if it is profit after depreciation? It will be given to us in the question if it is profit after depreciation and taxes. Cash flow, no, this is. What are you confused about? You have to read the question carefully. Yes, write down working note 1. Computation of base case NPV. Why base case? Because here right now we are computing, considering it at all equity finance. Okay, right? Computation of base case NPV. Right below. PV of cash inflow. PV of cash inflow is equal to, what is the cash flow after tax? Into PVIAF at for 8 years. That is 10 lakhs into, what is the PVIAF at 15% for 8 years? 4.487. 4.487 into 10 lakhs. How much you get? 44 lakh 87,300. This is the PV of cash inflow. No problem. No, 300 don't want. Keep it like this one. We have taken only 3 decimals. We are sticking to 3 decimals. This is the PV of cash inflow. What is the PV of cash outflow? How much are you investing in the project? It's given on first line. How much? 50 lakhs. So, the base case NPV will be PV of cash inflow minus, that is 44 lakh 87 minus 50 lakhs. How much? 5 lakh 13,000. The explanation of this was given to you in the class 3-4 times. Previously also I gave it. It is the PV factors of all the 8 years at 15%, the total of all of them. 3 times I have explained it to you in the class. Please go back and check how we have written it down. If you have doubts even after that, then after the class you wait and ask me your doubts. Is it clear till here? Base case NPV clear. Negative or positive? Negative, no? Yes or no? Everyone? Yes? Okay. There is one adjustment that we need to make over here. That is with respect to the cost of equity. That is with respect to the cost of equity. Now listen carefully. How much is the amount raised through equity? 26 lakhs. 26 lakhs is needed to equity after minusing the flotation cost, correct? Because 24 lakhs is from debt. So 26 lakhs should be received from equity after minusing the flotation cost. How much is the flotation cost? 5%. How much is the flotation cost? 5%. So can I say after minusing the 5%, what remains is after minusing the 5%, what remains is 26 lakhs. So can I say that the remaining balance is 95%, that is 26? Is this clear to you? Everyone, don't write anything, just observe what I am doing. So, the amount raised through equity financing is 26 lakhs divided by 95%. Why divided by 95%? Because 5% is the cost. So how much is 26 lakhs divided by 95%? 27 lakh 36,842. Is this clear? This is the amount raised. So can I say flotation cost is 27,36,842 minus 26 lakhs, that is 1,36,840. Is this clear to you? Everyone? This is the amount required to finance the project. Yes. 5% is the flotation cost. This is the balance that you need to have after payment of flotation cost. You remember I had told you net proceeds is issue price minus flotation cost. Okay. So issue price is what we are finding out over here. Flotation cost is what we have to ultimately figure out. 100% is what you will receive, but in that 100%, 5% is what you have to pay. After the payment of 5%, what will remain with you is 95%, that is 26 lakhs. Because that is what should be remaining with you to finance the 50 lakhs in the project. Is that clear? If you are saying that flotation cost is minus from this 26 lakhs, then you will not have 50 lakhs with you, you will have less than 50 lakhs with you. So to keep that 50 lakhs of the project, we consider that this 26 lakhs is after considering the flotation cost of 5%. So this 26 lakhs is your net proceeds. Net proceeds is nothing but issue price, which is 100%, minus flotation cost, which is 5%, that is 95% will remain. Is that clear? So 95% is 26 lakhs. How much is 100%? 27,36,842. If you do 5% of 27,36,842, you will get 1,36,842. Check. Yes, it should match. Is this clear? Now have you understood? Yes. So, to consider base case NPV, you have to minus this from the value. So over here, minus flotation cost. How much is the flotation cost? 1,36,842. So I just delete this. You can cancel it and write again, no problem. Tell me the final answer. 44,87,000 minus 50 lakhs. Again minus 1,36,842. What do you get? 6,49,840. Here, this is your base case NPV negative. Is this understood? So this one extra adjustment is what we need to incur and make over here. It's a little tricky, I understand, but let me just repeat whatever I told in here. You consider all the cash flows after tax, discount it using KE, not KO, and get the PV of all the cash inflows. Okay. Then you find out what is the flotation cost. Subtract the PV of cash inflow from the PV of cash outflows and the flotation cost. Flotation cost is already at present value itself because it is incurred in the beginning of the project. So minus them, you will get the base case NPV. Is it clear till here? Clear, everyone? No. See, only to calculate the base case NPV, we are considering it an all equity finance. That is to find out the PV of cash inflows. Then we get into the consideration of your debt. So why are we considering here debt separately is because each project will be financed with different, not each project will be financed with different capital structure. It's not like every project of 50 lakhs will have 26 lakhs of equity and 24 lakhs of debt. Okay, so they are saying that one more project which is of 50 lakhs may have 20 lakhs of equity and 30 lakhs of debt. So that project's KO and this project's KO will not be the same. So to consider that, we calculate it separately over here. It is not like we are raising the 50 lakhs of equity. We are raising only 26 lakhs. That is 27 lakhs and not. Okay, 26 lakhs will be the net proceeds that we have. The amount that is raised is only 26 lakhs. Okay, not 50. Understood? We'll take into consideration the benefits from interest on loan. Yes, that benefits will take it to consideration. Is that clear till here? Yes. Okay. Write this. Note 2. Note 2. Computation of flotation cost. Computation of flotation cost. Sorry? This one you didn't write. I gave you time to write. Write first. Write first, write this, then write that because everyone is writing this, right? Okay? Yes, I'll give you 1 minute time to write it, but first finish this. Busy talking. No, not talking. Note 2. First note you didn't write. No one wrote. No, did I give you time to write is what I'm asking. I gave you time, no? No, I'm confused. Done. Second note is done. Yes, those who have not written the first note, write it. Yes. Done. Done. had not taken the flotation cost, I had not taken the flotation cost into consideration because I had to give you an explanation of how the flotation cost works. Okay, since everything could not be done at once, I had not given you the explanation of how flotation cost works. So now you understand that base case NPV is not just PV of cash inflow minus PV of cash outflow. It includes the flotation cost because that is also an outflow at year 0. Now done. Done. Okay. Third working. Computation of present value of tax benefit on debt. Yes. Debt is repaid every year, correct? So how much is the repayment every year? It is 24 lakhs divided by 8 years, no? That is 3 lakhs. Yes. Okay. Now listen carefully. If the opening value of the debt is 24 lakhs, first year at the end of year 1, 3 lakhs is paid. So can I say interest for year 1 is going to be computed on 24 lakhs itself? How? See this. Year 0 to year 1. Year 0 you started with. Year 1 it became. So for the entire year you used 24 lakhs. At the end of the year only, no, you paid 3 lakhs back. So a bank will say, okay, no problem. You paid me back at the end of the year. You pay only interest for 21. It is about the usage of money, no? For how long have you used the money? So for 1 year, how much was used? 24 lakhs was used. The second year, your interest will be charged on 21 lakhs. Like that. Is that clear? Is this understood? Yes. So right. We'll do a table. Year, first year column. Then principal column. Wait. I'll write the table first. Then you can copy it down. Principal column. And then headings I'll write. Then you write the interest column. We are getting the tax benefit on interest. So tax benefit on interest. Then present value interest factor at 14% because that is the rate of debt, correct? Yes. And then PVIF of what? Tax. Present value of tax. Present value of tax benefit. Yes. Is that clear? Year 1, 2, 3, 4, 5, 6. How many years? 7, 8. Help. One more. Okay. Will they fit? Correct. That's what I do. You have to tell me. Today I Yes. Tell me, principal 24 lakhs. Then no, give me all the principals. 21. Then minus 3, 18 lakhs. Then then 12 lakhs, then 9 lakhs, 6 lakhs, and 3 lakhs. Correct? Yes. Interest into 14%, no? 14%. 3 lakh 36,000, then okay, 2 lakh 94. I'm believing you, I'm not checking. 2 lakh 52,000. Okay. Then hmm. Correct. Good. Everyone, it's just a reduction of 42,000 every year. Because 3 lakh has been reduced every year. 3 lakh into 14% is 42,000. So basically, first year interest minus 42 is second year. Second year minus 42 is third year. You can do it like that also. Because every year the amount of principal is getting reduced by 3 lakhs. So automatically the principal also will get reduced by 3 lakhs into 14% will be the reduction in interest. Yes, tax benefit on interest. How much is the tax rate? 40%. 40%. Tell me. Three lakh 36,000 into 40%. How much? 1,34,400, no? 2,94,000 into 40% is 1,17,000. Next, 1,08,000. Next, 84,000. 67,200. 50,000. Yes. 33,000. 16,000. Give me the present value interest factor at 14%. 0.7, then 769, then 592, then 519, then 3996, so 34, sorry, 0.4, 0.3996, so 0.4, 351, multiply. I think that you can do on your own. Yes, do it in here. Write it down. So I hope you have realized to discount the tax benefit on interest, you have to discount it using the PV factor at that particular rate, that is 14%, because interest is calculated at 14%. So to find out the base case NPV, you will discount it using KE. To find any other element with respect to debt, you will discount it using KD, that is 14% over. Is that clear? Because that is the rate of interest on debt. One lakh 17,869, correct? $90,434. 68,040. 49,728. 34,877. 22,982. 13,440. 5,000. Total 4 lakh. Anything else that you're saving? No. Why are we computing this? Because when you pay interest, your profit will reduce. When profit reduces, the taxes also will reduce. So every year you have a tax benefit of this particular value. Multiply it with the PV factors, you'll get the present value of the tax benefit. Is that clear? So this is the benefit that you get when out of the 50 lakhs, 24 lakhs is invested, is borrowed through debt. Is that clear? Everyone? Done? Everyone? Yes? Write down next. Finally write down. Adjusted NP. Base case NPV plus present value of tax benefit on what? Debt. What is the base case NPV? We have found it already. 6 lakh 40 842. What is the tax benefit on debt? 4 lakh 3,267. So what is the final answer? Negative 2 lakh 46 570. So is this beneficial as per the adjusted NPV concept? It's not beneficial. Is that clear? Yes, with this all the concepts of this chapter are completed. I had given you one homework, no? 10th question, correct? MIRR and modified NPV. IRR and MIRR. Can we finish that also? Quickly discuss it all. Question number 10, no? Done? Yes. IRR and MIRR. Okay. At 10%, what was your NPV? 1,08,130. Correct? Yes or no? Okay. You have to find IRR. IRR means what? The rate at which PV of cash inflow is equal to PV of cash outflow. Okay. So you have one rate where you have found the NPV as 1,08,130. That is what rate? At 10%. Okay. So you have to go for a higher rate. Okay. Have they given to us in the question which rate we have to use? No, they have not given to us in the question as to which rate we need to use. So which rate shall we use? 30. 30. 30 and 32. In between 30 and 32 is the answer. Yes, it should be beyond 2025 itself because there's a huge difference between NPV at 10% and definitely 0. So we have to go for higher discounting rates. And this is the reason why I told you that usually in the exam they would mention to us as to what is the rate that we need to use, because practically speaking it becomes very difficult for us to sit and analyze as to what rate do we need to use. But why did I tell you to do it on your own? Because I wanted you to solve things and get NPV on your own. So it becomes a practice for you to solve the NPV concepts as well. Okay. Shall I use 30 and 32? Yes. Okay. What are the cash flows after tax? 90,000. IRR I'm doing, okay? Tell me. 90,000. 80. Okay. 2 times 90, then 2 times 80, and finally, okay. So next, PVIF at 30%. Tell me. 1.3, 0.76, 9, 0.592, 455, correct? 350, 0.269. I think individually so you can find only, no, give me the total. Sorry? 2 lakh? 3,000? 63, 30. You took 4 decimals. Oh. 30. I think this you can do it on your own, right? PVIF at what? 32? Yes. 1 by 1.32, 0.75? 0.574, yes. 0.435, 0.329, 0.2. And if you find the discounted cash flows after tax, you will get 1 lakh. Exactly. 96,000. Those are solved. How many have actually solved 30 and 32? Anyone has done any other numbers? 30 and something else, or 31 and something else? Any other numbers you have taken? You can let me know. Okay. Fine. So now, how does the IRR calculation go? Lower rate plus, what is the lower rate? 30 plus. What is the NPV at lower rate? Yes. 2,03,030 minus 2 lakhs. 3,030 divided by 3,030 minus of minus 4,000 into what is the higher rate? 32 minus 30. So here 3030 minus of minus becomes plus, plus 4000, 7030. So 3030 divided by 7030 into 2 plus, you get 30.86 percentage. Everyone? Yes. Then what else have they asked in the same question? MIRR. Okay. But to find MIRR, have they given us reinvestment rate? That is not given, so we'll assume it to be equal to cost of capital. Yes. Good. Okay. So to find MIRR, what is our first step? PV of how much is that? Next, second step. Future value of cash inflows. That is, you take all the cash flows to year, which year? Year 5, correct? 5, no? By using reinvestment rate. If reinvestment rate is not given, then the next better one is cost of capital. Okay. So what is the cost of capital in this question? 10%. Okay. So year 0, you don't get anything. Year 1, what is your cash flow? 90 or 80? 90. Oh, 90,000. Year 2, 90,000. Year 3, year 4, and finally year, how much? 60. Can I say this 90,000 will be taken forward by 4 years, this by 3 years, this 80 and the next 80 by 2 and 1 years respectively, and the last 60 will remain as it is. Okay. So future value of cash inflows 90,000 into 1.1 power plus 1.1 power, 80,000 into 1.1 power plus 80,000 into plus 60. Yes. Can you give me the answer of this in one step? Let me just check once. I know you'll be correct, but I'll just verify. First one is 1,31,769 M plus 1,01,790 96,000 88,000 plus 60 4 lakh 96,350. Correct. This is your future value of cash inflows. This you have to discount it at the rate which is MIRR, and you will get the PV of cash outflow. So 2 lakh is equal to 4,96,350 divided by 1 plus MIRR to the power. Interchange the places. You get 1 plus MIRR to the power is equal to 4,96,359 divided by 2 lakh, that is 2.481795. Okay, because you will directly do it in the calculator. Yes, from here you will apply that square root 12 times minus 1 divided by 5 plus 1 into equal to. Yes, I'll do it once quickly over here. So when you press square root 12 times, you will get 1.0002219. From that you will minus then you divide by 5, you get 0.00004438881. Then you add 1, then you do into equal to 12 times. What do you get? You get 1 plus MIRR is equal to 1.0002219. 1994. Shift this one here, you get MIRR is equal to 19.94 percentage. Anything else that I've given as homework? No. I think something else, but I solved it in the class. Correct, no? Previous topic, what I gave as homework, I've sent you the solutions. This topic, whatever I gave, I think I'll solve it. Yes. Okay. Fine. With this, capital budgeting is completed. Just one quick 5 minutes revision to just recoup whatever we have done. Okay. So we did payback period, which is in how many years are we getting the initial sum of investment back. Okay. Then we did payback reciprocal, average cash flows divided by initial investment into 100. That's a percentage. Higher the better. Then we did payback profitability, that is anything that is after the initial investment total, that is the yes. Then ARR, which is nothing but accounting rate of return, average net income divided by original investment or average investment. What is average net income? All the net income, profit after tax of all the years divided by number of years. Profit after tax, not cash flow after tax. These are the methods. What is average investment? Initial plus scrap value divided by 2. Then we did NPV, PV of cash inflow minus PV of cash outflow. Then we did profitability index, PV of cash inflow divided by PV of cash outflow. Then discounted payback period, same concept. Only thing is you don't take the cash flow as it is. You discount the cash flows and take it into consideration. Then IRR, just now I discussed how to find IRR also. Then MIRR, modified NPV and adjusted present value. When will MIRR and modified NPV come into picture? When the timing of cash flows are different. When you have comparable projects and when the timings of cash flows are different, that is where MIRR and MNPV will come into picture. When will profitability index come into picture? When the cash flows of, that is initial investment of two projects are different, and also when you're doing capital rationing, right? There also the initial investments of projects are different. That is when profitability index will come into picture. Then we did what is capital rationing, divisible and indivisible projects. I think that's all. Equated annual cost and equated annual benefit, that comes into picture when there is life disparity. Correct? That is, the life of one asset and the life of the other comparable assets are different. Is that clear? Yes. Now, when it comes to the full-fledged questions of NPV computation, the first thing is to figure out what are the cash outflows. Then it's to figure out what are the subsequent cash inflows. And then it's to figure out what is the terminal value of cash. Usually inflow only. Terminal value will be inflow. Once you figure out these three things, you will end up getting the NPV answer. Discounting rate and all that will be given to us in the question. Again, remember, 2 questions of NPV is asked in the, not NPV, 2 questions of capital budgeting is asked in the exam. It could come from profitability index, it could come from payback period, discounted payback period, anything could be there. I have given you the question papers, I have shared the question papers across. Just go and have a look at what are the different types of questions that is asked. Analysis, I'll share it with you. Just have a look at what are the different types of questions that is asked. Okay. I think we can stop the class here for today. Hopefully tomorrow we have power, and so that we can start the new. I don't want to start a new chapter with this particular environment. Answer key of the test, I'll share it by today, or we can discuss it tomorrow after class. Let's see how it goes. Okay. Either I can share it today or we'll discuss it tomorrow after class. Some of you had doubts, say back and let me know. Some of you wanted me to show the QR that way. Yes.